providing critical infrastructure and essential services to communities in around 20 countries. Our operations span CPB contractors, Leighton Asia, UGL, Thiess, Sedgman, and Pacific Partnerships. We have expertise across the life cycle of asset, infrastructure, and resources projects. We give assets a performance advantage, create infrastructure with future generations in mind, and unlock resources for maximum productivity and output.
Hey again. So before we start with CIMIC, a few reflections on Turner. Turner is a great company, very well established in the US. But more importantly, the value that Turner provides to our clients is migrating into Europe, Asia Pacific, and Australia. And this is one of the examples on how ACS is becoming a great platform where all the companies are working together. SourceBlue, that it's not just a very powerful supply chain organization, but it's also allowing the rest of the companies at ACS to use SourceBlue in the rest of the geographies. And we expect SourceBlue to grow significantly beyond what has been in 2023, more than 1 billion revenues with a margin. And all the clients from Turner are being used as well by the rest of the companies. So they are being shared with the rest of the clients and the companies, how to work with them, how to do engineering with them. Now we're going to move with CIMIC, which is exactly the same approach. It's a very well-diversified company with a lot of clients in the natural resources space, critical metals, industrial, and we are using all those clients and all those connections to move in Europe and in the US, right? So with that introduction, let's talk about CIMIC. You all know CIMIC, more than 125 years of history, more than 30,000 employees, and 13.3 billion of Australian dollars in 2023. 87% of the revenues are in Australia and New Zealand, with 12% in Asia. But it's, as I said before, very diverse organization. 86% of projects are with repeating clients. Turner also gave similar figures. And as we move into these high growth segments and high tech, this is very, very important because it's about trust, as I said in my introduction. This is the only way to achieve higher margins. When you become more sophisticated in your approach, in your value, in your engineering skills, in the supply chain. CIMIC is a perfect example. 90% of the contracts have been renewed over the last 5 years. You will see in the picture, we are doing a lot of infrastructure work for defense in Australia. We are doing a lot of infrastructure for defense in Asia Pacific. We are doing right now in Germany and the eastern countries of Europe and in the US. One example was the Pearl Harbor upgrade contract from Dragados. And all of that is interconnected as well as another example of interoperability between the different companies in ACS. These are the 2023 figures of CIMIC that you know very well, but in summary, it was a robust performance through a very disciplined delivery, cost control, and risk management. 13.3 billion Australian dollars of revenues, 494 million Australian dollars of PBT, 113 net operating cash flow with 32 billion backlog in Australian dollars. And CIMIC, as the rest of the companies in ACS, is also moving into these high growth areas. And it's probably the most diverse, as I said before, organization in our platform. Because not only works in all the high-tech segments, like data centers, like battery fabs, but also is very, very strong in defense, very strong in natural resources, critical metals, etc. And we are going to continue increasing that over time we believe that we're going to be able to increase our margins as we deliver more sophisticated segments. Our growth is very much based on the fundamentals of Australia, because a big part of CIMIC is in Australia. And the fundamentals of Australia are great. Just the projected population by 2070 gives you a sense of how much investment Australia is going to bring. There's 790 billion Australian dollars in investment outlook from 2024 to 2028, just in infrastructure construction. But there's 6% of growth per annum in all these mega trends from 2024 and 2028. Special mention, the growth in defense. As I said before, it's a very important part of our growth, especially when it comes to the infrastructure associated to it. And we do have security clearance from the US to Europe to Asia Pacific and Australia. And in our figures in 2023 and the backlog, you will see reflected this fact. So these are the three building blocks within CIMIC of our value proposition. First, all the engineering-led services, UGL, Sedgman, Light and Asia. This is everything that has to do with integrated solutions segment that I was describing in the first part of my presentation. UGL is #1 in Australia in engineering services. Then we move into natural resources, critical metals, global sustainable mining, #1, TIS. But also TIS and Sedgman are our most global firms. So they don't work just in Australia, but they do work in Indonesia, in Philippines, in Mongolia. They work in the US, they work in Canada, in South America, especially Chile, Peru. And they have a track record in Botswana, and they continue to expand, especially in the North American market. And then when it comes to engineering and construction, CPB, very strong. And CPB has one very good feature. And it's one feature that the rest of the group is taking advantage, their ability to work in remote areas. Most of the projects right now are very complex, and it's very difficult to isolate the civil component from the energy, from digital, from the way you integrate robotics, etc. And this is why we're so strong in bringing all the companies together. But there's also another component that is very important to deliver these projects, which is the ability to move resources, people, the ability to work in remote areas. And CPB has been doing it together with TIS and UGL for the last 100 years. This is key. No matter if you are working in some of the big gigawatt data centers across the world, or the big battery fabs, or some of the future semiconductors facilities, all the new prospects on the natural resources, they are in very difficult areas, sometimes in the middle of nowhere. So understanding how to do project management in those regions is key. So having said that, let's go more in detail through the different segments.
Thanks, Juan. My name is Doug Moss. I'm the Managing Director for UGL. I've been part of the group since the early 1990s, since 1992 in fact, and I'm based in Sydney, Australia. If I start with UGL, the company that I manage, we have been in operation for 125 years. So it's certainly been around for a long, long time in Australia, very, very deep roots in Australia. We are the Australian leader of high-value engineering services, and we are specialists in the end-to-end engineering, industrial services and operational solutions. We employ over 1,000 design and technical engineering resources in Australia, and that is really what sets us apart from the market and from our competition. Our total workforce is approximately 12,000 people, so we are a large business in the Australian context. At our core, we deliver mechanical and electrical and control systems infrastructure to a wide range of the Australian market across energy, industrial services, mobility, technology and defence. So we work pretty much across the entire sort of country in all the major sectors. We are arguably Australia's #1 designer and deliverer of mobility and energy assets, and the market leader in the design and delivery of transmission lines. All those things, of course, very important for the energy transition. Now, Sedgman, the second of our companies, has a similar sort of engineering pedigree to UGL. They've been in operation for over 45 years, and they focus in minerals processing solutions to the natural resources industry. It has engineered, constructed and operated more than 250 processing plants in Australia and North America, has deep expertise in critical and battery mineral processing design, and is growing into the critical minerals necessary for the energy transition through mergers and acquisition. It is the Australian market leader in its sector. The third business which I'd like to introduce is Leighton Asia, a high-tech specialist with more than 30 current projects throughout the region. Its operations cover Southeast Asia and India, with Malaysia, Hong Kong and the Philippines accounting for about 65% of the company's business. It is the contractor behind some of Asia's most prestigious projects, including Hong Kong's largest and most complex off-site fabrication scheme and the world's largest underground railway station. It is also a very well-established player in technology and data centres and is known for its best practice, construction methodology and digital engineering expertise. And currently is expanding into advanced manufacturing. With that, I'll hand over to Michael Wright, who will talk about TEAS. Michael.
Thanks very much, Doug. Yeah, my name's Michael Wright, the CEO of TEAS. I've been with the company for 25 years. In fact, Doug employed me 25 years ago into TEAS when he was there as well, so we know each other very well. So very proud to be part of the group. I've worked in Australia and overseas, and for the last decade or more into mining. TEAS, importantly, is the global leader of diversified mining services, providing open cut and underground mining and asset management solutions to clients all around the world. Yesterday was a really great day for us, 16th of April. We were founded 90 years ago, so we celebrated our 90th birthday yesterday, which is great. And we had a good celebration on the weekend just gone for that back in Australia. So with that 90 years of experience, we've got more than 60 projects across 7 countries, across Australia, Asia, North and South America. And I think importantly, as you heard from Peter earlier, TEAS also has a strong commitment to our people, their development and critically their safety and well-being. And that's resulted in TEAS having a global safety record that is the envy of the mining industry. There's nothing more important than our people and having a safe and respectful workplace. And it really does bring a competitive advantage for TEAS in our global mining business. We're positioned at the forefront of sustainable mining with a strong focus on technology, rehabilitation, remediation, emission reduction and decarbonisation, which the world needs, and certainly mining has that challenge in front of it. And our strategy is one of diversification, with commodity diversification into critical minerals and metals, diversification through services into asset management and sustainability solutions, and expanding our geographies into mining jurisdictions where we can bring great value through our expertise and also our global supply chain. I guess in the last 2 years, we've expanded in the US with a really strong pipeline of opportunities in critical minerals and metals in front of us. And we've used strategic acquisitions, which I'll talk about a bit later, to really diversify our commodities and our services globally. We're now also into our 4th year of a 50-50 joint venture between CIMIC and the Elliott Group, which Juan mentioned earlier.
Thank you, Michael. Thank you, Doug. So moving into CPB. CPB has been our civil engineering company for a number of years in Australia. In fact, has been alive for over 97 years. It's a trusted construction partner. And CPB was one of the first organizations to convince clients to move into this collaborative approach that we always refer to. In Australia, the complexity and the size of the projects also taking into account how limited is the access to people, to skilled labor, and also with the fact that there's not so many construction companies push a lot of the industry to come with better contract models. And CPB was pioneer in moving in that direction. CPB has also been focusing on the energy transition, has also been supporting significantly UGL in their tech infrastructure projects, and both together has significant
Absolutely.
JVs across the board. The project management skills from CPB in remote areas, which is very, very common in our civil construction organizations, joined with engineering, mech, industrial capability, and advanced technology of UGL. It's a perfect combination. That model not only works when it comes to Australia, it's working between Hochtief Dragados with Turner. It's also working in North America when you see a lot of the JVs between Dragados, Flatiron, and Turner. So it's a very important part of our platform. CPB is also a pioneer in a lot of innovative methods when it comes to environment. The statistics in the construction are unbelievable when it comes to recycling, to use of non-potable sources of water, how they are reusing all the materials, waste, etc., is second to none. And as the projects continue getting more and more and more larger, bringing different disciplines, how they are being able to bring customized solutions for our clients is key. So which are our key differentiators? First, that we're an integrated platform. Second, the discipline, the risking approach, and this is something we'll continue repeating throughout the presentation. And third, how unique we are positioning ourselves in the next generation sectors. This is an example of how we use the platform. We could use exactly the same slide in Europe, in North America, or in Australia, Asia Pacific, and how we are integrating all the different companies towards the same goals. On one hand, we have Pacific acting as a developer and acting as the final owners. Some projects, not all the projects, only the ones that require equity with the possibility of owning the asset in the last place. Pacific, in the case of Europe, that position is taken by Iridium and by Hochtief PPPs, and in North America by ACS Infrastructure. But it's exactly the same model. Then we do have all the different capabilities across the board. The industrial capability on engineering, manufacturing, industrial services from UGL, the way that this has diversified mining operations with the asset management and rehabilitation of mines. Then Sedgman through the end-to-end mineral processing capabilities. Lighton for the high-tech and advanced manufacturing in Asia Pacific, and CPB with not just the engineering and construction, but the project management capabilities. You can replace those figures or that and those companies for Dragados, Hochtief, Turner, etc. Right? So there's an intercompany collaboration so we can successfully deliver these critical projects. Now, let me move to a case study, which was the Sydney Metro. And basically, this is what we did. I mean, it was pretty much involving the energy, the systems, the mechanical leg. We had the investment from Pacific. But in total, we were able to build 110 kilometers of tunnels with 15 billion between all the share of work that we did in the organization.
So I'm going to talk then about the next two key differentiators. The first of those, which I'd like to talk about, is the disciplined approach to de-risking our projects. Now, a key differentiator for CIMIC is its approach to risk management, and we're very, very good at that. We use collaborative models increasingly to mitigate risks and produce better margins and shorter project delivery timeframes. There are several of these models which are in use in Australia. They all include the incentivisation of all project partners and a significant early contractor involvement to de-risk things like the design and the planning phases of the project. In terms of the commercial models, these are not fixed price or lump sum contracts. They are generally undertaken as cost plus, cost reimbursable, or pain gain share type models. The key differentiators here for us are our technical capabilities, what we bring to the clients, the certainty of delivery in terms of certainty of the outcome, and of course the strong relationships that we have with our clients. The outcome of these types of models are fewer cost overruns, a much better understanding of the complexity of the projects, providing program certainty for the benefit of all the participants, the clients and the contractors alike. Collaborative and low-risk contracts are an increasing part of the CIMIC backlog. In the figure here on the slide, you can see that we have increased them as a proportion of our backlog from about 65% in 2021 to circa 80% in 2023. And that trend is continuing into the future. So here, a case study of one such project. This is a joint venture, one of the ones which Juan was talking about, a JV between UGL and CPB, to build a $1.4 billion high voltage transmission network in New South Wales, one of the largest energy projects which has been built in the country at the moment, and the first of many, many transmission line projects. We have a strong relationship with this client. UGL has been working with them for over 60 years, since the early 1960s in fact. So the financial model, which is shown there on the slide, provides that the downside risk is capped at our cost. So we always get our cost under all circumstances. We can't lose money. But the upside is shared between us and the client. And there is no cap on that. So again, we are fully incentivised to work closely with our client to sort of minimise cost, to maximise productivity, shorten the duration of the project. Everybody wins. If we win together. Very important. So fully aligned. Now these sorts of models are becoming increasingly common in the energy sector, but they had not been a feature of that market until recently. And this is because governments, clients, need to get this work done quickly to meet our commitments in terms of decarbonisation. So a positive trend, and it's something which is going to continue quite a bit. Now, the third of the key differentiators, which I'd like to talk about, is our positioning in these next generation sectors. These next generation high growth sectors, much like you heard about from Turner. Now, CIMIC is particularly well placed in critical minerals, biopharma, healthcare, education, social infrastructure, digital and technology, and of course in the energy transition and sustainable mobility. You can see here the evolution of our backlog just between 22 and 23. Energy transition, mobility and critical minerals are the areas where our backlog has grown the most. In energy transition by about 1.2 billion, sustainable mobility by 1.5 billion and critical minerals by 1.2 billion. Now we're going to go into some more detail on two of those sectors, namely the energy transition and critical minerals on the next few slides. In my opinion, these are not short-term trends. You're going to see more and more of this work. The investment that's coming is huge in Australia, as Juan touched on, and so we're going to see a real positive trend towards these types of projects over the coming years. So if I just go to the energy transition first, I'll give you some more background on that. What's driving this? How big is it? Now, CIMIC is sort of ideally positioned to assist Australia to meet its ambitious targets, which have been set by the federal government. Those targets include reducing emissions by 43% off 2005 levels by 2030 and achieving net zero by 2050. To achieve these goals, we will need a massive investment in renewable energy generation capacity by more than 9 times. Some people would say 12 times what exists today. So we're talking about going from 30 gigawatts of installed generation capacity to more like 300 gigawatts in that period. It's a massive, massive scope of work. Big dollars as well. Some people sort of estimate this at something like 400 billion in today's dollars. That's just the generation component. On top of that, to go to sort of use renewable energy, sort of solar and wind primarily, we need to invest heavily in what we call firming assets. These are the assets which store the energy. So when the wind doesn't blow or the sun doesn't shine, we still have power for our homes and for the country. So we're talking a massive investment. CIMIC is a leader in all of these sectors. And to date, we have delivered 14 solar farms over the past couple of years, about 1.2 gigawatts of installed capacity. 5 wind farms, about 800 megawatts of installed capacity. 8 utility battery energy storage systems, which represent about 3,000 megawatt hours of storage capacity. And importantly, we secured 3 of those projects in 2023, and there's a massive pipeline of those projects coming to us as we speak. We built over 280 substations, over 7,000 kilometres of high voltage transmission lines, and we're currently building a 660 megawatt hydrogen-enabled gas turbine power station in New South Wales. So We're in every aspect of that transition, every single piece from the start to the end and everywhere in between. There's just a case study here for us. Done a lot of projects for our good client Neoen. This is the Victorian Big Battery, the VBB as we call it. It is the largest battery energy storage system in the Southern Hemisphere, just outside of Melbourne in Victoria. 450 megawatt hours of storage. Very close relationship between UGL and Tesla, so we're using Tesla's technology. UGL sort of integrates those technologies from OEMs overseas, bring them to Australia, and then support them in terms of the implementation of their technology. So a lot of engineering, all done in-house, again, by our engineering team. So great depth of capability in this space, Juan. And I think I throw over to Michael.
You do.
I do now
Thank
to
you
talk
very
about
much, Doug.
minerals. Thank you.
Good. So I guess, look, TEAS by numbers up on the screen. We turned over $5.9 billion of revenue last year, heading towards 6.5 this year, so that's consistent, strong growth, strong EBITDA, as you can see there, and again, strong growth in that EBITDA with the long-term clients. We've got the work we do globally, the scale, the supply chain, etc. We've got over now, today, more than $15 billion Australian of backlog. So we've continued to grow that from the end of last year, which is important, and that gives us that long-term sustainable cash flow. We've got profit, as you can see there, which again is on a growth trajectory moving forward. Importantly, on this slide, I guess we've got, there's currently discussions ongoing, as Juan mentioned before, about CIMIC/ACS acquiring a further 10% stake in TEAS. We're currently 50-50 with CIMIC and Elliott, and so that's ongoing at the moment, which, if successful, will result in the financial consolidation of TEAS into CIMIC. As mentioned earlier as well, some acquisitions that we've been focused on, really trying to position TEAS for the critical minerals and the energy transition in the future. Next slide, I'll talk a little bit about MACA, but MACA we acquired 18 months ago. We've been integrating that into our business, and as I said, I'll talk about that in a minute. And PYBAR, importantly, is a company that within 2 weeks of today will take over fully. It's an underground mining contractor focused on metals and minerals and brings that critical service to the critical minerals clients that we're working with and will continue to work with, both in Australia but also exporting that service overseas, which is critically important. So a couple of case study here around the MACA acquisition. It was a listed company. We competed against it slightly in some areas, but really the important thing about MACA for TEAS was to bring that commodity diversification, services diversification, particularly looking forward with our strategy focused on the global energy transition. So we've extended our commodities portfolio into new critical minerals, more copper, more lithium, nickel, more gold, molybdenum as well. And I guess importantly, last year alone, we secured $1.7 billion in new contracts in metals and minerals. So we're continuing to grow as we integrate MACA into the TEAS family of businesses. We've also increased our client base, and again, through MACA's long-standing focus on client relationships and contract renewals, being completely aligned in culture to TEAS's same focus, again, engendering that long-term cash flow, which is critically important. We've also benefited from the synergies of bringing TEAS and MACA together, and we'll do so with PYBAR as well, of people expertise, of our supply chain, our global supply chain, which is second to none in our business, and the systems we've got to running and mining operations. We've delivered $21 million in synergies to date and another $20 million more identified, which will come into effect in the next 12 months. And I think importantly as well, together, since coming together, above our financial 22 year pro forma of TEAS and MACA, we've improved our EBITDA by 15%. And again, we're going to see further growth in that as we move forward. Importantly as well, to touch on Sedgman. Sedgman, through an M&A strategy, has really positioned itself beautifully in the critical minerals area as well. consolidating its position as a global leader in minerals processing. It's boosted its engineering capabilities, which is critical for the energy transition, so getting involved in the projects much earlier, expanding into new geographies as well, critically. So through NovaPro, through Minsol, Prudentia, bringing capability in engineering, in manufacturing, in processing, in lithium and energy. And so critically important to Sedgman's future strategy in critical minerals. So Juan?
Thank you, Michael. So a few conclusions about CIMIC. The first one is how well positioned is in Australia and New Zealand, which are very important markets with very good and fundamental metrics. We also are seeing an increase in spending in those areas, especially following the population growth that they are experiencing. And our integrated platform is well positioned to pretty much approach and absorb most of that spending. We continue to de-risking our backlog, as we were doing in the rest of the geographies. And we believe also that not just in our traditional segments, but also in the high-tech and new growth vectors, we are going to be able to succeed. And that will continue bringing opportunities. When you look at the engineering capabilities that we have in manufacturing, in industrial, in energy transition, in high-tech, and now through all these acquisitions in the natural resources space and critical metals, we're also going to see very good opportunities to invest our equity. And we will be talking a little bit in some of the next sessions about it. So thank you so much, and we'll move into the next session.
Thank you.
For over 55 years, our mission has been the development, delivery, and operation of infrastructure projects aimed at creating value through a whole life cycle approach, sound risk management, and a focus on safety, innovation, and sustainability. We partner with clients around the world to modernize and expand their existing assets and to accelerate the delivery of new critical infrastructure to meet the ever-growing needs of society. These collaborations unlock ACS Infra's full potential for value creation. And as our society evolves, we now look into the future with a renewed focus on digital infrastructure, energy transition, and smart mobility, investing in a more sustainable and connected world.
Hi, good afternoon, everyone. I'm Pepe Aljaro. I'm the Abertis CEO, and I'm very pleased to have the opportunity to introduce and to present Abertis to the financial community. Abertis was delisted 6 years ago, and now I'm feeling like a flashback, really. But having said that, the Abertis today is a much better company, is more profitable, is more sustainable than 6 years ago. That means it's a great pleasure to be here. We have prepared a presentation with 2 blocks. In the first, we talk about Abertis overview and strategy I will present to you, and the second part will be presented by Martín Duba, is our CFO. We are aware that the market has some concern about Abertis and some issues like dividends, debt, capacity to replace EBITDA, etc., etc. I hope that through or after our presentation, we can help you to avoid or to eliminate some of those concerns. Abertis today is a pure global toll road operator, well diversified geographically, and today we manage high-quality portfolio of assets. We manage around 8,000 kilometers through 35 concessions. Abertis is a global diversified operators, as I said, with activities in 10 countries, and that's allowed us to protect some local disruptions. And third, Abertis has a very good industrial expertise that help us to boost our profitability. In 2023, Abertis presented very good track record, very good performance. Basically, the top line has been growing plus 8%. EBITDA achieved 3.9 billion, increased plus 10, plus improved the margin, plus 7%, 70% EBITDA margin. And also, we had, at the end of 2023, 160 billion EBITDA backlog. We introduced in our presentation, in many cases, this figure. And we talk about backlog because we consider it's more representative of our company due to, in our portfolio, we are including some assets that today generate limited amount of EBITDA, but in 10, 12, 15 years, we will double the contribution of those assets. I mean, that is necessary to take in consideration. And Abertis has been very profitable in the last 5 years. For that reason, we paid 3.6 billion dividends in the period 2019 to 2023. You see in this graphic what is our current geographical diversification, but also what will be the diversification of our backlog per country. You see today, France is our main contributor with the 36% of the EBITDA, but also we have a good balance in other 4 countries with contribution between 12 and 15%. And you see there is in some areas like US and Puerto Rico with limited contribution today, only 6%. But if you look at the backlog, will be the main contributor. All in all, we maintain a good equilibrium between hard currency countries and soft currency. In both cases, we present more than 60% of the EBITDA is coming from hard currencies. Abertis is building a perpetual value creation model, and that is built through 3 different pillars. The first is the platform for growth. It's a good platform, and we have shown how able we are for growth through different ways. I will explain later. The second pillar is the strong financial discipline. We apply very prudent, very conservative financial policies, and also we have a commitment to maintain our rating level. And the third is the operational excellence. We manage in a very proper way our assets, and that allows us to improve the profitability of all the assets with different actions that our management implement in the portfolio. If we go to the first pillar, is platform for growth. When we talk platform for growth, we are talking about 3 different ways for growth. The first is the organic growth. The second, optimization of the current asset, and M&A. Organic growth. You know that our top line is growing linked to 2 elements. One is traffic, and the second is toll rates, is tariffs. In both cases are linked to other macroeconomic elements. It's linked to GDP and linked to CPI. In both cases, we have a multiplier, positive multiplier, and that's also improve the sustainability of our profits. Only with this element, considering only the organic growth, we are able to maintain the 600 million dividend a year, only with this element. And on top of that, I'm going to explain the other 2 components for growth. Optimization. From time to time, we enter in discussion to revisit our contract, and we try to obtain additional profits through win-win agreement with the different grantors. And the third element in which we have been able to create significant value in the past is M&A. We are growing in a very selective way but in a very profitable way. Here you see another graphic showing our positive view about the macroeconomy outlook. In this graphic, we present the GDP and CPI in some geographical areas, in Europe, in US, Puerto Rico, and also in three of our main countries in South America, like Chile, Mexico, and Brazil. You see that together, in the case of Europe and US, we expect to increase both elements together in 3.5, 3.3, 6 in Europe and America, and also in South America above 5.5%. That together is helping us to improve our organic growth. But on top of that, we have positive multiplier, as I said, due to the quality of the asset or the different agreements in the different administration. In some cases, we increase tariff above inflation as a consequence that we are implementing extra capex. And for that reason, that extra capex is compensated with additional tariff increase. All in all, we expect to increase our EBITDA in a recurring way in the next 3 years in plus 7%. I insist that this is excluding any additional renegotiation of the contract or excluding any additional M&A. If we go to the second way for growth, is optimization of our current portfolio. I mean, we try to maximize the value of the existing assets. I mean, all our management is focused to identify opportunities to review or revisit contract and to open discussion with the grantor. On that case, always in a win-win situation, we extract extra value. It's a negotiation to improve very often the life of the concession. You have some example in this graphic. I mean, our track record in the last year was very significant. More than 66% of the concession has been extended. That is show you the capacity of our manager to achieve this type of agreement. But not only we did this negotiation, but also we have under review, under discussion, new opportunities, especially in Brazil. Today we have under discussion the possibility to extend some of our concession in Brazil. I mean, we are relatively optimistic to achieve an agreement, and that will allow us to extend some of them. And a part of that, we have some ideas for new extension in Mexico and even in Puerto Rico, and we will see an example a few seconds later. And the third way is M&A. I mean, as I said, we want to grow through new concession in our portfolio in a very selective way. We are very prudent, choosing the right country with a strong legal framework, and also we apply the right return. And then Martin will explain a little bit more about the return that we're asking for. But at the same time, we succeed in the last 5 years in different acquisitions, ERC, RCO, 288, Puerto Rico Toll Road, and also Autovía del Camino. But additionally, our management team is working, and now we have identified 9 new opportunities that could contribute with an additional 40 billion EBITDA backlog. That means today we have the M&A team very busy. It's possible to disclose some of these assets that we are analyzing. Other, for confidentiality reasons, is not possible to disclose. But let me to say something that is public. We are involved in the tender of Sasir assets. We have to present the binding offer at the end of May. We have another asset under analysis in Chile, Santiago Los Vilos. We have to present the final offer beginning of June. We have in the second phase in an asset in France, A154 is a new concession in France. I mean, you see that we will continue working on that, and that will be on top of the 7%. Okay? This is a good example how Abertis managed his portfolio. We started in Puerto Rico with very small asset. Next step, we improve our presence in the country, acquiring Metropistas. Then we increased the stake in Metropistas, and finally, we extended Metropistas. And now, recently, at the end of 2023, we acquired a new portfolio of 4 concessions. I mean, that is a normal way how we manage our business. If you remember, I said we have 3 pillars: growth, and the second one is strong financial discipline. On that case, Martin will explain deeper our financial policies, but I would like to remark 3 topics. The first is we have a very good protection of the increased rate. That means significant part of our debt is in fixed rate, and we have only 18% variable rate, but we apply a very dynamic policy. The second is maintain our current rating as investment grade, rated by S&P and Fitch. And the third is to manage and to maintain a good capacity to deleverage the level of debt. You see in this picture that the absolute term or volume of debt has increased 13%. But really, we deleverage the company in like-for-like term. But at the same time, we have been investing 10 extra billion in M&A transaction. For that reason, in absolute term, we are increasing. In relative term, we are decreasing. But even in relative term, the net debt EBITDA was 6.6 in 2018, and now 6.3. And I said, not in the EBITDA, we are including the capacity to generate EBITDA with the recent acquisition. Because today, those acquisitions are in a ramp-up process. That means in 10 years, the EBITDA will increase substantially for the same level of debt linked to these assets. Okay, but then Martin will explain deeper. And the third pillar is the excellence in asset management. I mean, I said we have a good management team. If you look at this graphic, we have been able to generate 300 bips profitability above the macroeconomy element. Why 300 bips in the last 10 years? One is due to the high quality of the assets. For that reason, we are performing traffic better than GDP, good located, good area, good regions, etc., etc. The second is our capacity to implement efficiency program. I mean, we reached 1.3 billion cash saving in the last 10 years. It's a lot of money, really. And that was applying efficiency program and also to implementing best practices between the different countries where we are working. And the third is synergies. When we buy something in a country, the plug-and-play integration is very easy. It's very efficient. I mean, these 3 components help us to improve the profitability of Abertis. And finally, as I said, Abertis today is managed like a perpetual value creation model with capacity to replace EBITDA. If you look at the EBITDA in 2018, it was 3.5 billion, and now 4.1. This is a pro forma basis. It's including the new acquisition that we completed at the end of 2023. But, I mean, we lose in the meantime 900 million euros EBITDA, and that has been replaced by 1 billion euros in these 5 years. No question about our capacity to repeat the same strategy going forward. The second is capacity to increase the backlog. We double the volume of backlog in our company. And the third, we have the capacity to generate strong cash flows. A strong cash flow to deleverage the company and to maintain and sustain, to maintain the dividend policy in the coming years, at least at the 600 million euros. But it's a good combination between dividends, growth, and deleverage. This is Abertis today. I passed the floor to Martin to explain the Abertis financial review.
Thank you, Pepe. Hello, everyone. So I wanted to provide a few additional insights into how our perpetual value creation model works from a financial perspective. I'll show you a bit more of how it's worked in the past and what you can expect from it in the future. But first, let's start with some basics of how the model works, what it's made up of. Well, it's made up of two key components. First, as Pepe said, our diversified, strong portfolio. Second, we complement that with an optimized financial structure. And what do you get? You get recurring, strong cash flows that we use first to pay down debt, second, to pay dividends. And in paying down debt, that deleverage creates firepower to further invest in value-accretive growth, which then strengthens our portfolio, and so the cycle can continue on and on. Now, let's go back to the key components, our portfolio. Now, Abertis is quite large and arguably complex. So we try to simplify, and let's remind ourselves that we are made up of individual core infrastructure assets. These are high-quality toll roads that are doing exactly what you expect them to do, which is generate strong recurring cash flows. Why? Because we're providing an essential service to our communities, mobility. We do that with assets that are protected by high barriers to entry. You can't just build another road next to ours. Third, demand for that service is linked to GDP. In fact, as Pepe said, we consistently outperform GDP growth. And last, our regulated tariffs give us protection against inflation. So what do you get? Well, if you look at our portfolio today, the assets that are out there today, if you look at the last 10 years, you saw Juan and Pepe quote 7% CAGR over the last 10 years despite COVID. Now, that's a long period of time, and that's a big CAGR. So what does that mean? Our portfolio has doubled its EBITDA over the last 10 years. Doubled their EBITDA. So please keep that in mind when we look into the future later. Now, another thing to remember is every one of our toll roads goes through its own life cycle. And every toll road may be at a different point in that life cycle, but they all follow the same trend, especially two key trends. The first, it starts from a higher level of leverage, and that leverage goes down over time thanks to those growing cash flows. And as that debt goes down, our ability to pay dividends goes up. And we are made up of a number of toll roads that are all following those trends, and therefore we as Abertis in aggregate will be following that same trend. So please keep that in mind later as well. Now we combine that with an optimized financial structure. So what do we mean by that? Well, Pepe mentioned that at a corporate level, at a topco level, we have a BBB and BBB- rating, an investment grade rating that we plan to keep. But what we often forget is that each of our assets that is rated has a solid investment grade rating as well, which is a testament to the quality of those assets, to the prudent leverage of those assets, which ultimately translates into an ability to upstream dividends to Abertis. Now, you also see in terms of how we structure the debt that roughly half the debt is at topco and half is at the opco at the asset level. And that's something that's not a coincidence, it's something that we actively manage. Why is that? Well, the debt at the opco level, at the asset level, has a benefit that is non-recourse debt, and it's in local currency, which allows to mitigate currency risk. But at the topco debt, we have a debt that has a lower cost because, of course, it benefits from our large, diverse portfolio. So we have low leverage at the asset level, 3.2 times net debt, and then when you look at it on a consolidated basis, that's still a prudent 6.3 times. Now, I like to think of our debt as our financial structure as being low risk, low cost, and well managed. In terms of low risk, Pepe touched on, we have good protection against interest rate movements. Over 80% of our debt is fixed rate, but you should also know that some of our key assets have 100% protection, 100% fixed rate. Now, another element obviously is refinancing risk. Now there, again, something that we actively manage, and during the last 5 years, we've managed to keep the average maturity of our debt at over 5 years. So what does that mean, let's say, for the next 3 years? So we've got about 3 billion euros of maturities every year for the next 3 years. Just a big number to some, but for us, it's very manageable. Why? So first, we've got over 9 billion euros of liquidity. That's very strong liquidity that, of course, we'd rather not touch. And we don't have to because of the strong cash flows. Strong cash flows that actually mean that if we do nothing, if we don't need to raise additional debt or anything else, our actual refinancing needs, instead of 3 billion, go down to 1 or 1.5 a year, which is a very manageable amount given that in the last 5 years, we've been raising about 5 billion euros of debt every year. So again, we're comfortable with that. So low risk ultimately has to translate to low cost. And we've benefited from a stable low cost over the last 3 years. So our topco debt has had a cost of 2.1%, despite we all know what interest rates have done. And we expect that to remain at a quite stable 2.5% in the next 3 years. And that's a testament not just to our portfolio, but how we've managed that financial structure. And it's worth noting, for example, early in 2022, before interest rates started going up, we entered into a 4 billion euro hedging program, which created a lot of value for the group. And for example, that meant that we were able to reduce the cost of our last bond issue in June last year from 4.1% down to 2.4%, again, helping us keep that cost of debt low into the future. Perhaps the last component, if you like, of our model, which is value accretive growth. Now, value creation can mean a lot of things to a lot of people, but if we try to look at it simplistically from a financial perspective, value creation is achieving a return on your investment that is above your cost of capital. So let's look at what that means. Let's take an example of, we're looking at an asset that has an equity IRR of 8 to 10%, depending on its risk profile. Well, our cost of capital is very efficient and obviously lower than that, so hey, we're already creating value. And yet for an industrial group like Abertis, that's just the beginning. Why is that? Well, first, that 8 to 10%, in our case, thanks to our industrial know-how, that means that the projections that are underpinning those returns are more reliable. So already there, we're de-risking that 8 to 10%. But we don't stop there. We're able, as Pepe said, thanks to the breadth of our portfolio, thanks to best practice sharing, we're able to extract synergies, optimizations. We will constantly look at ways of improving, enhancing, extending each of those assets, and in some cases, add platform M&A. So what started as an 8 to 10% can easily end up at 10 to 14%. And that is what we do in all of our acquisitions. So let's look at what this has done in practice over the last 5 years. So we've generated, over the last 5 years, over 10 billion euros in free cash flows. And what have we done? We've used 6 billion to pay down debt, first step, deleveraging, and 4 billion to pay dividends, including in the last few years, the 600 million, as you know. So what has that meant? Well, that means that we started with 23 billion of debt, and we've been able to reduce that to 16 on a like-for-like basis, excluding growth. That means we brought down the leverage from 6.6 down to 5.4 times. Now, you won't see these numbers in our reported figures, and that's unfortunate, but that's what's happening underlying. You do see net debt going down in the years that we don't make acquisitions. So if it's 2019 or 2021 or 2022, you'll see that net debt coming down. We are deleveraging, but of course that's what creates the firepower for growth, and that's what we've done. So again, in the last 5 years alone, 11 billion euros of investments, about 10 billion euros into M&A, and over 1 billion euro in growth capex, which are those extensions that Pepe mentioned. It's a lot of investments in a short period of time. So how have we funded that? Well, we've been able to use that deleveraging capacity to fund most of that. Obviously, it's a lot in very little time, so we had to top that up with some equity. And what do we get? What has the model delivered in the last 5 years? We've increased EBITDA by 16%. We've doubled our backlog, and yet we've only increased our net debt by 13%. And in fact, our net debt as a multiple of EBITDA has come down. So that is why we firmly believe that we're in a stronger position today than we were 5 years ago, and how we've delivered on the model. And again, it's unfortunate that if you look at just the reported figures, some of these numbers don't pop out. You have to normalize. You have to normalize because, for example, in the last year, when we did a couple of acquisitions, at the end of the year, the debt was added to our balance sheet in the last minute, and yet we got no EBITDA for it. That is why, as Pepe said, we need to pro forma for acquisitions and normalize. And last year, that 1.3 billion of capital increase came in March this year, not last year. So you have to be able to see through some of these numbers, which I'm sure, and I know a lot of you are doing, but it's important to remember that. So that was the past. What does the future look like? Well, I'm going to show some projections that will be shared with you as well. We try to keep it simple, and our projections are for the current portfolio only. It doesn't include any extensions, any M&A, which again are part of our model. So if we look at the next 10 years in aggregate, then we'll break it down. But in the next 10 years, our current portfolio will generate 27 billion euros of free cash flows. That will give us a capacity to pay down 16 billion euros of debt and to pay 11 billion euros in dividends, including 600 million to our controlling shareholders every year for the next 10 years. So that will allow us to reduce our current 26 billion of net debt down to 10 billion, including a significant reduction in the topco debt, and bring down leverage from 6.3 times down to a very low 2.5 times. And what will we have in 10 years' time? We will still have a business generating 4 billion euros of EBITDA and with 110 billion euros of portfolio, of EBITDA backlog. So that's 27, 28 years of EBITDA life still left in our portfolio in 10 years' time. So we still have a strong portfolio, which we have deleveraged, and again, that's what gives us that firepower to reinvest in growth. Now let's break it down into some of the key components. So first, EBITDA. Again, these are numbers for the EBITDA current portfolio. So we start at the current level of 4 billion, and we peak at about 6 billion in 2030, continuing the trend that those assets, how they've been performing for the last 10 years, and hopefully with no more COVID. So we peak at 6 billion, and then we have some of our key concessions in France that currently would expire. So naturally, that EBITDA will come down. But for the next 10 years, we've still got about 4 billion euros on average EBITDA coming out of our portfolio on a like-for-like basis. Again, without extensions, without growth. So it's a solid cash generation for the next 20 years, and we still end up with a backlog of over 70 billion euros, which, by the way, is roughly where we were 5 years ago. And we're still going to have that in 20 years' time. Now, I have to admit that as management, we don't particularly like this curve, and we're not obviously sitting and doing nothing, so we're going to continue to actively manage, actively look for growth extensions, and you can rest assured that this curve will look different in the future, same way that it looks different today from what it was 5 years ago. Now let's look at debt, deleveraging, the first key part of the model, key part of the model, if you like. We talked about the debt going down from 26 billion down to 10 in the next 10 years, and you see the drop in topco debt is fully repaid in 15 years by 2038. So topco, all that debt that is there today would be gone, so it's a strong deleveraging capacity. Every day we're paying down that debt. And we reduced leverage from 6 times to 4 to 2 and to below 2, which obviously is a very low level. So what we've done is we've put in some recaps at the end, but strong capacity to deleverage thanks to the strong cash flows. And again, this is without any extensions, without any M&A. That is what this will provide us firepower for. The last component, dividends. So we have modeled that, as Juan mentioned, quite simplistically. We've modeled 600 million euros of dividends paid to our controlling shareholders in the next 15 years. That coincides with the full repayment of the topco debt. And obviously, those cash flows, the less debt there is, we can use more of those cash flows to pay dividends. So even though we could probably increase the 600 million earlier, you can see after 2038 a significant increase in dividends. And again, that is without including any extensions, any M&A, which will add to the value coming from these dividends. So thank you. I hope that has been insightful. I do want to leave you with 5 key takeaways. First, the perpetual model works. We have the track record of being able to replace and grow EBITDA. So as Pepe said, we have the confidence that as some maturities come in the future, we'll be able to manage those and keep growing our business. Second, it's a strong cash flow generation, because each of the assets that we have are core infrastructure, quality roads that are doing what they're expected to do, generating predictable, recurring, and growing cash flows. And we start off with 160 billion euros of EBITDA backlog. Third, prudent leverage. Sometimes people, without doing the normalization, wonder, is that too much debt? Well, it's not. I hope you've seen today that, first of all, we've been deleveraging. We've just used some of that capacity to fund growth and make us stronger. And we have a clear path to continue significant deleverage over the coming years, just with our current portfolio. And with that portfolio, sustainable dividends. We have the ability to continue paying 600 million euros a year to our controlling shareholders until the end of our concession life. And we have the capacity to grow those dividends. Remember, as we deleverage, we can pay more dividends. And we're not just going to sit and do nothing. We're looking for that perpetual growth. We've been doing that for the last 5 years. We've actually been doing that for the last 60 years, actually. And we're not in a rush. We're going to continue to be selective and apply financial discipline, but that is the last element that will keep that perpetual value creation model going in perpetuity. So, thank you.
Hi, everyone. I'm excited to be able to join you today to get to talk to you about our greenfield opportunities that we have and our greenfield investments that we do within the group. So I'm Nuria Haltwanger. I'm the CEO for Iridium, and I'm here to talk about ACS Infra and tell you a little bit about who we are, what we do, which I think we do quite well, and where we're going into the future. And so in terms of who we are, ACS Infra is comprised of Iridium, Pacific Partnerships, and Hochtief PPP. And we're a global leader in greenfield infrastructure development and long-term O&M. We're a diversified platform with significant returns, cash yield that adds value along the whole value chain, and with what we call the multiplier effect with other entities within our group. And these are a few of the metrics that we think reflect that we do a good job at this. So we have a long and successful track record of managing and investing in very big, large infrastructure projects, many of them considered mega projects. And we've historically invested in almost 250 of them. So that means we have experience in managing them and structuring them financially, oftentimes with project finance. And in doing this, we optimize our investments throughout that life cycle, helping generate a return, a strong equity IRR of almost 17%. Our current portfolio will generate over the next 10 years 160 million of project dividends. And we believe that that creates a fair value in terms of the current portfolio that we have of our core infra platform, and I'll talk more about our next generation, of 2.7 billion. So our focus really is about value creation across the full value chain. And so that starts with our development activities. And so we have an extremely successful bid ratio, hit rate. So that means that in the last 5 years of the projects where we've decided to bid, because we're selective in where we go, and the resources that we put forward in identifying opportunities, the projects that we go to, we win, in the last 5 years, 65% of those projects, so about 2/3 of those projects. And we have a multiplier effect with our investments, which means that for every 1 million euros that we invest in a project, we usually are able to generate about 23 million of revenues for our construction entities and other entities within our group, as well as separately a long, stable cash flow of O&M backlog. So we currently have about $3.6 billion of O&M backlog, mainly focused in North America. And then the last part of this value chain, which is really important in terms of what we do for ACS Infra, but for the group generally, is our strategic divestments and equity rotation model. And so we successfully do that by selling portions, oftentimes either a full concession or portions of our concession equity investment, in order to generate a 2.2 times exit ratio compared to equity invested. And that money we can use to invest in new projects going forward, which again has that multiplier effect along the value chain. This shows you our portfolio, which, as I said, is well diversified, and it's well diversified in three ways. We're diversified in terms of geography, and so we're present in all of the major places where we do business, so North America, Europe, Asia Pacific, and Latin America. We're also diversified in terms of our core infra, specifically in terms of sectors. And so we've traditionally been very focused in transport, so we have significant road and rail assets within our portfolio, but as well as facilities. So social infrastructure projects, including hospitals, student accommodation, and other public types of facilities. And then I'll talk more about the bottom portion later on, which is what we're calling the new generation infrastructure. And then we're also very diversified in terms of revenue streams. So we have a good balance and mix between availability payment projects, which provide for stable cash flows, as well as demand risk projects, which help provide for opportunities for higher yield. We're focused on strengthening our core segments, and I'm going to talk first to that, but also unlocking the value creation that we're able to get from our next generation infrastructure. So I'm going to focus a little bit just to tell you about the pipeline that we have for our core infrastructure. And there's great opportunity in respect to our core infrastructure, mainly because there's always this ever-increasing gap between the infrastructure that's needed and the infrastructure that countries and states are able to actually invest in. So that unlocks opportunity for private initiative and private investment, and that's where we can come in. But we have a focused and diversified platform of projects that aim, but it's selective. And so that's an important part of what, this is first very illustrative of what we have. We have a long pipeline that we study. But we've tried to just highlight some projects here that highlight the diversification of sectors that we look at, as well as the integration that we have. But also, very importantly, we're very selective in the projects that we pursue, particularly aimed at making sure that they meet our risk profile criteria. That's a shared allocation of risk, particularly on the construction side. And that is really focused, and we're pushing clients more and more, and because we're able to do that together with our other group companies because of the reputation we have in the market, to help push the models of bringing more and more features of collaborative, alliance, target pricing into these types of P3 models. And so we're actively doing that, and these projects help highlight that. As the people here know, I can speak in detail about each of these. I won't do that because I know I'm standing between you and lunch, so I'm going to try and keep it moving. But I do think we should highlight a few of the projects that we're tracking, particularly the managed lanes projects. And so managed lanes is a very large asset class that we're seeing that's going to continue to grow, particularly in the United States. And for those of you who might not know, managed lanes are basically congestion relief lanes that are built usually on existing highways that will be tolled. And so we're seeing more and more of those projects coming out within the United States, helping to address congestion in the growing cities. And one of the programs that we're very involved in is part of the Georgia Major Mobility Investment Program. We're currently bidding in that program with their first project. That's an $11 billion program with a number of projects that are set to come out, with the first one that we'll be bidding coming up this next month, which is the SR 400. Nashville and Tennessee will be coming out with a program as well, a large program with these projects. as well to address congestion that they have, and they're calling them choice lanes. And then we're following them in Virginia. We also here have, like I said, a brief selection of projects that we have on the social infrastructure space. We're following a number of projects in Australia. There's going to be a pipeline of hospital projects coming out. And then a few of the others that show and highlight, particularly one of our water projects that is very interesting in Manchester, which is really bringing in the concept of target pricing model, and we're pulling that into this P3 model. As well as our Denver Airport and CONRAC and APM project that we're going to be looking to bid together, which will bring together ACS infrastructure with Turner that will focus on the CONRAC, which is a consolidated car rental facility at the Denver Airport, and the APM, which will bring in the expertise from Flatiron. So we'll be doing that collaboratively together. So as I said, our core infrastructure, and this sort of highlights, you saw this a little bit before that Juan was able to explain, but this highlights where we're looking to sort of allocate our resources and what we view that the value that will bring coming up in 2030. So core infrastructure, we're looking, based on our pipeline, our selective pipeline, we'll be looking to invest still about a third of what our equity is going to be, investing forward. And that, we believe, comes out when we look at our traditional exit valuations, would be equity value of about $3 to $4 billion for that pipeline. And that's just as it relates to the equity investment piece. That doesn't include the multiplier effect of what we're talking about in terms of the construction revenues or the O&M. Then we'll be looking, and I'll be talking more in detail about how we're going to be looking at these, what we're calling the next generation. But I think it's important to sort of understand what we're talking about when we go there. So as I said, we've historically been, and we're involved in critical infrastructure going forward and developing whatever the needs were of the moment for our clients. So roads, bridges, highways, ports, high-speed rail, hospitals. We've been involved in that. And as the needs of the society and as the needs of our clients have changed and evolved, we've changed and evolved with them. And right now, digital infrastructure is becoming ever more critical as a need that we have, as are renewable energy sources and alternative and more sustainable means of mobility. So that's what we're doing. We're changing with our clients and with the needs to serve and approach those segments. But we're doing them through investments in areas and these growth vectors that are, in essence, very core adjacent. So we're doing them into core adjacent industries and where we already have group expertise. So we're able to leverage our group expertise in order to position ourselves within each of these. I think, as you can see, and I'm going to talk more specifically about each one, so I think this was just so you can have a good overview. Again, as I said, we're really looking at leveraging the expertise that we have, and I think you've gotten a good highlight already from the presentation that Turner made in terms of where we are in terms of expertise in data centers. You were able to hear from Doug at UGL in terms of the expertise on the renewable energy side. We have collaborations that are already happening. So even though we're calling these, next generation or new infrastructure, they're not new for our group. They're not new in terms of the expertise that we bring from the different group companies. So turning to the digital infrastructure and what we're looking at. The market right now is experiencing a huge paradigm shift in terms of need because of the growing demand for cloud computing solutions, as well as the disruption that's associated with AI. So that's the basis for the anticipated growth that we're seeing in the data center market in general, which by 2030 is expected to be about $500 billion of revenues in terms of the market. And our strategy to participate in this from an equity level is really based on three fundamental pillars. And this is, I think, a really good example of us, we are in the right places at the right time and with the right skill set. And it's actually, as we look at each of the new generation sectors, that really is what it is. we exist, and our geographical scope is where these areas are growing. We're there, it's the time, and we have the right skill set. So we're going to be leveraging our ACS group footprint and expertise, and I think it was spoken well in terms of the Turner presentation about we have all of the major relationships with hyperscalers, which are 80% of the clients that utilize and are going to need data center space. We have within the group 1,500 dedicated data center experienced professionals. We have in-house land assessment capabilities because in the end, the data center business is really about land, power capacity, water as well. And we have the ability and the logistics supply chain through SourceBlue to be able to help achieve that, and renewable energy and nuclear energy expertise within the group that's also going to help us look to add in some off-grid energy solutions to this product offering. We're going to be looking to provide the end-to-end solutions to act as the developer and investor, and then we'll also be looking at some M&A bolt-on opportunities. So we're targeting right now about 1 gigawatts of data center capacity by 2030. So that translates, in essence, we believe, into a value that will require about $1 to $2 billion of investment, and that translates into up to $5 billion of value by 2030. Again, without taking into account the multiplier effect as it relates to the construction opportunities that helps bring. And we're already well on our way to helping achieve this. We have a number of projects already. We have a good example, and you'll hear a little bit more about it later, is our project Alcalá here in Madrid. So Madrid is one of the growing areas that we believe in, and places, Spain in general, for data center growth. We are already in construction on this project, and we're looking to go into operations in 2026. We're doing this project together, and it's a good example of our integration that we're doing because it's a project ourselves, Iridium, together with Dragados and Turner, who are helping construct that project. And incorporated as well within our overall data center strategy is a focus on sustainable edge data center solutions, which are actually being developed and is a really unique product offering that's being developed through Hochtief throughout Europe. And so these are focused on edge data centers, which are smaller in size, but is one of the fastest growing areas within the data center market. And they are looking to already identify 10 locations for data centers by, within the next 12 months. And you'll hear more about this unique, sustainable data center approach later in Martina Stephan's presentation. So it's a very interesting product that we're also doing in this space. Energy transition, I think Doug actually did a really good job of sort of explaining, particularly in the Australia market. So our energy transition and renewable energy strategy is focused primarily through Pacific Partnerships in Australia. And we are looking to pursue this because of the need that I think Doug did a good job of explaining in Australia in terms of investment that will happen in renewable energies. They are at the forefront of the transition with renewable energy solutions going to be one of the largest infrastructure segments in the country for the next decade. They're having to transition from a coal-fired based power load, and they're having to transition over in order to meet their 2050 energy net zero targets. So they're going to have to make significant investment in next generation storage, grid stability, and upgrades. So Pacific is already targeting, and we're targeting to do about 5 gigawatts, and they're well on their way. They already have 2.5 gigawatts of projects that are they're currently developing or have exclusivity rights on, and we believe that translates again into by 2030 an equity value of about $2 to $3 billion. again, without counting the multiplier effect as it relates to construction and O&M. Green hydrogen, we're also focused on the green hydrogen space. I think Juan did a good job as well explaining our strategy as it relates to green hydrogen. We believe that this is going to be a core vector and driver going forward in the future, and we're trying to position ourselves with the expertise that we have within the group, particularly UGL, in terms of their strength on the technical side. These are our 4 pillars in terms of our strategy of how we're looking to do this. So we're going to be focusing on, key projects in key markets. The benefit that we have actually is our global presence is exactly where a lot of the green hydrogen solutions are going to be developed in the future. And so we're able to do that. So this is, again, another example of we're in the right places for this opportunity. But we're actively monitoring it to make sure that the business model meets our very stringent equity requirements in terms of investment. And so again, Juan highlighted them of what they were. It really is making sure that we have, a strong offtake agreement, that we have the right renewable energy source coming in, that we have, the right technology as it relates to electrolyzer technology, and a business plan that makes sense, often going to draw upon subsidies, which we're tracking and that have been announced, but we have to see how those actually will play out in terms of being able to do our investment. Having said that, we're well positioned, and we actually identified a solid, very real pipeline of about 5 gigawatts of capacity, and we'll be ready to enter into that once we continue to move forward and diligence that and make sure. So our goal would be to reach about, at that moment, if the moment is right and when the moment is right, to invest about 2 to 3 gigawatts of capacity, of electrolyzer capacity. So sustainable mobility, and so I get the honor of getting to, explain some of our exciting things that we're doing in terms of sustainable mobility. Sustainable mobility, the way we sort of describe it, is really about the fact that as populations are growing, they're becoming more and more urban, and there needs to be different solutions in order to be able to address those needs. And so part of this, we anticipate actually that by 2035, the global market for what's defined as sustainable mobility, which is quite large, is going to be about 1 trillion euros. And we're investing in and partnering with some of the companies that are helping lead different solutions as it relates to sustainable mobility. I'll talk a little bit more about them in terms of skyports and glideways, so I'll be able to describe them more. But one of the other aspects that we're doing in terms of sustainable mobility is really focusing on the EV charging. So we're addressing the ever-expanding use of electric vehicles and investing in EV charging market opportunities with 150 charging stations in execution currently and another 650 under development. And we have a strong growing pipeline, particularly in the European market, through HOCHTIEF, who's actually developing and won one of the largest public procurements for EV charging in Germany. We're looking to expand that business, going into other countries, and also looking at truck charging. So in terms of what the market itself is, this is very, again, selective market because the market is quite large. But we're looking to do an equity investment of about 360 million. That's what we've kind of anticipated for the next few years. And we believe that that equity value, I would say conservatively, is around over $1 billion. And so now I'll get to talk to you a little bit about one of our opportunities that we have. So we recently did a significant investment in Skyports, which is I would say, the global leader in advanced air mobility. And so advanced air mobility has been a business that's been growing, and to date has had already about 9 billion of investment, but that's really been focused on the technology for the aircrafts, whereas that $9 billion has gone to the technology to develop the aircrafts. And as those aircrafts and the OEMs are getting ready to final certification, now is the time to be investing in the actual ground infrastructure that's going to help make this industry grow. So we did this by participating and by buying a 50% controlling interest in Skyports, which is the #1. Skyports we would say, the global leader in advanced air mobility and has 2 really interesting components to its business. It is the leading developer of ground operating infrastructure, or vertiports, for sustainable urban air mobility. And they also have a very interesting beyond line of sight drone services logistics business, which, for example, they're the only company in the world that can do cargo deliveries to offshore oil rigs right now. So they have this very interesting other aspect of their business. But we really focused on them because of the infrastructure development side. So they're a first mover, one of the first movers in advanced air mobility, and they developed the first fully integrated vertiport in Paris. They have another 2 in California and Singapore. And they recently, the video that you're seeing is actually from Dubai, because they won the exclusivity for 10 years they will be the exclusive vertiport developer and operator for all of Dubai for the next 10 years. Again, we have the 50% controlling interest in Skyports, and that also gives us preferential rights as it relates to equity investments in the projects that they're going to be developing, as well as the construction. So again, this multiplier effect on our investments. And then again, as I said, as it relates to the drones logistics business, it's focused on beyond line of sight cargo surveying and monitoring, and we're actually looking at how we can bring those efficiencies into our broader group, and looking at how we're going to bring those synergies to our construction, mining, and asset management areas of the group. The other thing that I get to talk to you about is glideways. So we have a pretty modest investment that we made into glideways, but what that investment in glideways does, and I'll explain what glideways does, which is focused on personal rapid transit. But what it's actually unlocking for us is the opportunity to invest in what we believe is going to be a very large, growing infrastructure mobility solution to participate, again, with the multiplier effect in the construction and in the investment in the projects and the concessions that they're actually winning. So the glideways concept, I call it where Uber meets mass transit. So it's basically small electric autonomous vehicles that are on demand, but that they run on dedicated lanes and guideways. So the benefit of this is that, and they can run nonstop. So it runs within a mesh network. So if you were thinking about being in being basically on a metro system, but you get to call the car to you when you're ready to take it. It will take you on your dedicated lane, and it will drop you off at the station that you want to go to without stopping in between, and in a private car experience. So you're not sharing that experience with anybody else. The benefits that this actually has, and we're seeing it play out with our public clients, is that it provides a mobility solution that's actually high capacity mobility solution, but at the fraction of the cost, because it requires much smaller CapEx. And mass transit solutions are usually designed for peak hours and for peak utilization. But that means that there's a lot of hours where trains are running, and they're running half empty. By being on demand, there's actually huge OpEx savings. And so what this modest investment is giving us is an opportunity to participate in the construction of some of these projects. And so they're an industry leader. We actually found them because we were participating in a bid with probably the only other entity that's doing personal rapid transit, but Glideway's technology is much more advanced, I would say, or their solution is much more advanced. And they beat us in a procurement. And so if you can't beat them, buy them, or buy the piece of them, so that you can participate with them. And we're actually now participating with them in that project in San Jose, as well as East Contra Costa, which is another project that they won, together with Flatiron. And we're currently bidding a pilot program at the Atlanta airport with them, together again with Flatiron. So this is a great entry point for us into the autonomous vehicle space. But it's actually, because it's on a dedicated lane or a dedicated guideway and not open road, it's actually able to be utilized now, and it's providing a technology solution for the needs of today. So we think this is a really exciting opportunity. And again, very modest investment, but it's giving us the opportunity to partner with them on exciting other projects. And then related to the fact that, as we've been talking, all of these sustainable mobility solutions that I've been talking to you about are all electric and battery powered. So part of that comes with the need for increased and an ever-increasing need and demand that we're going to be seeing for lithium. And so one of the other aspects that we're currently exploring together with our other group companies, particularly benefiting from the expertise of Sedgman, are some opportunities within the growing need for lithium, particularly in the EU. And we're going to be focused on, and we're analyzing some opportunities going forward in the lithium space as well. And so, just in terms of the key takeaways, because like I said, I'm between you and lunch, we're a successful platform for investment. We have a history of profitability with a very solid return that we provide for the group in terms of our equity investment. We help provide the strategy of and a great exit ratio in terms of exit multiple to equity invested. We have a multiplier effect, and we have large opportunities in our core segments going forward. But we also see solid value creation that we can unlock across the different new growth vectors because we're able to leverage our geographic scope and the expertise and partnership that we have and integration we have with our other group companies. So thank you so much.
Good afternoon. We hope you enjoyed lunch. We're going to start the second part of our presentation today. We're going to begin with the engineering and construction segment. So we will call very soon Santiago Garcia, who is our Chief Executive Officer for Dragados, and will come on stage together with David Parker and Richard Grabinski. Both of them work in North America. They understand engineering and construction in North America. They've been there for a number of years. And between the three of them, will be able to give us visibility on the segment. We will continue on ESG. We will invite at that point Martina Stefan, who is our Chief Human Resources Officer for both ACS and HOCHTIEF, and Christine Aldamith, who is also our head for not only ESG matters, but also operations at ACS Group. And then after that, Emilio Grande, our Chief Financial Officer, will be able to go through all the details around the numbers, and I'm sure you're waiting for that. Right after, we'll go to the conclusions and Q&A. So I hope you find the second part of the presentation very productive. Thank you.
ACS Group is at the forefront of the development of traditional infrastructure projects in civil engineering and construction. We integrate cutting-edge technology and solutions to provide communities with transport routes, high-capacity connections, and essential services such as water supply. We have the best and most dedicated talent to develop and transform key infrastructures to enhance communities' quality of life. We're building major projects that promote efficient environments and easy access to vital services, fostering social cohesion, like motorways, bridges, hydraulic infrastructures, railways, and public facilities.
So good afternoon, everybody. I'm Santiago Garcia, CEO for Dragados Group. And here with me, Richard Grabinski, who is the Chief Strategy Officer in Flatiron, North America, and David Parker from Dragados USA, who is the responsible for bidding and business development. We appreciate your presence here. You could be in the rooftop, and it seems like it's better for you to be here, so we appreciate it. So let's go with ACS Engineering and Construction. What's ACS Engineering and Construction today, and what are our levers for the better future? First of all, you know us, what we do. We do civil construction. We've been doing civil construction in complex projects all around the world where we can demonstrate and make the difference with others, as we are always in the forefront of the industry, due to our technical capabilities, our skills, etc. Where we mainly operate? In the most developed markets. That's it, North America and Europe. You can see in the graph that our revenues in 2023 were 60% in North America, United States and Canada, and then 39% in Europe. Within the three companies that are Flatiron, HOCHTIEF Europe, and Dragados, are combined in the top 5 contractors in North America and Europe, and in all kinds of rankings like the ENR, it's a prestigious ranking, and that every year they renovate our ranks. For instance, last year, 2023, Dragados was ranked top 3 transportation constructors, same with Flatiron in other categories, and the HOCHTIEF Europe as well. Well, what are we doing not now, just some years ago, and we are continuing now, is de-risking our profile. This is the main message I would want to take clear to you. We are de-risking our profile, our backlog, through to collaborative contracts. We're going to take time in explain what is a collaborative contract, which I will do later on. And just for you to know that more than 65% of our pipeline for future projects is in this kind of contracts. And then, of course, at the same of the other companies in the group, and taking advantage of the synergies we have and the power we have with the rest of the group, we are deep inside in growing in high growth tech market. No? It's not a target for the future. We already are in a third of our backlog in this kind of projects, no? Mainly in sustainable mobility, biopharma, health, education, and keep going. No? So what we do, you know us, what we've been doing for decades is very important flagship projects, building. We're doing successfully during all the years and in different countries. Why? Because we are in the forefront in the industry. Why? Because we have the skills, but we keep on investing in having the skills. I mean, we keep on investing in business development, in research, in innovation. We don't do things as we did last year. We continue improving ourselves to be the leaders wherever we are. This was always like that. It's what we learned when we were younger, and we do for the future. What is our backlog like? Of course, mostly it is transportation, no? Because we have more 50% of our backlog in transportation, and you can see residential, etc. But there is 20% of our backlog currently in sustainable mobility and other segments growing. Some projects, we could put a lot of projects here. We build bridges, we build railway, we build roads, dams, tunnels. We are tunneling now with 11 tunneling boring machines, which is a machine that can do it. At the moment, 11 in the United States. So just to put 3 examples, one of each company, we have more than 1,000 kilometers of high-speed rail in Spain with dragados that permitted us then to export this technology to the rest of the world. We are working in this kind of projects in the United States, for instance. This iconic project of Hot Chip Europe in Prague, which is the renovation of this historical building of the Opera House. Just one example, could put much more. And this one of Flat Iron in California, Los Angeles, which is a collaborative contract, and is the dynamic toll facility for a very good client of them, which is LA Metro. Only a few samples. Figures. Don't want you to see much figures than this because I don't want to bore you, but you can see here our behavior the last 2 years and what's our upward trajectory. So in revenue, from 2022 to 2023, our growth was 8%, which was from 8.3 billion euros to 8.9. Same with the PBT, from 141 million euros to 164, it is a 16% of increase. All of this is going to continue because we have a backlog of 3 years, actually, and a backlog that is, remember, de-risking itself, so it's going to be better. As a result, the free cash flow generation, which is in the end what matters more, is being so healthy and it's going to be better. It's around 145 million average these last 2 years. Just to give you some figures of what we are today. But what are the levers that will support the future? The present, but the future of ENC. The present, but the future of ENC. The present, but the future of ENC. Easy, no more, 3. First of all, we are positioned and we'll continue being positioned in the main developed markets in the world, mainly North America, United States and Canada, and Europe. We don't need adventures, any other areas. No, we are consistently positioned there. There are huge opportunities there. They are still growing. David is going to talk about this in a few minutes. And we have the presence, we have the skills, we have the credentials. The clients know us, we know the clients, we're doing it successfully, we will continue, not change. Then, second lever, we are fully committed in these companies to de-risk our backlog. So we are going to proceed through collaborative contracts. We already have a lot of in our backlog. Our pipeline, you saw it, is 75% or more coming. And we will get time to explain you what is a collaborative model, what is the difference, and giving you some examples he will do, Richard. And we will give you a couple of examples, because we don't have more time, I will give you more, that you will understand that this is the path. And the third lever, as important as that, is that we are, with the rest of the group, taking advantage of the tremendous power of this group and the synergies, getting into the high growth segments. We already are there. We're going to see that we had several projects ongoing, and we're going to give some examples later on.
what their new reporting structure is. Let me show you for the first time how our 2023 numbers look like under this new structure. First highlight in my mind is integrated solution is the biggest contributor already in 2023 in terms of revenue, profit, etc. You can see there the PBT 944 excluding extraordinary results. The contribution of Turner and CIMIC as part of the integrated solutions is around 65% of the profit that the business is delivering once you adjust for headquarters. E&C contribution of 164 million PBT in 2023 altogether as a segment, which represents around 15%, and infrastructure 227 million in the period, representing around 20%. So this is how the business will be reported going forward, as I said, and the headquarters line will cover all the costs that sits above the business, and on an NPAT level will also include the financial cost, obviously, that sits in both structures. Okay? So this is the numbers for 2023. The expectation, as I'll cover in a minute, is integrated solutions with high growth opportunity and margin expansion, both for Turner and CIMIC, E&C, a stable contribution also with growth in margins and good opportunities in the markets. And infrastructure in the period 24-26, more stable but long-term value creation as we direct investment to that segment. On the right side of the slide, you can see we're just maintaining our guidance we announced in the full year presentation just a couple of months ago, but given the new reporting structure, we adapt to the bottom line net profit. So it turns into 8 to 12% guidance for 2024. So now that we've covered 23 and 24, let me just run through the targets that Juan outlined in his presentation and that we have set ourselves as targets to deliver in the 24 to 2026 period. We are very confident in our market position and the organic growth opportunity in the business to deliver these targets. Let me start with revenue. We're expecting a 9% CAGR to the middle of that range that we show in the slide in terms of revenue. This is on the high end, and this applies to all the targets. On the high end of the targets, we are including the consolidation of these. So 9% or around 7% or 6-7% like for like without the consolidation of these. In terms of net profit, our target is to move from 600 million in 2023 without extraordinary results to a range of 850 to 1 billion in 2026. It's important to say here and state again here that the upper part of the range includes the consolidation of these, which would obviously contribute net profit on an attributable basis by 2026. And that means a 14% CAGR in the period, a solid 14% CAGR in the period. In terms of net operating cash flow, we are targeting to achieve a 3.3 to 4 billion net operating cash flow number in the period for the group. This is at a group consolidated basis, right? I'll refer to that in a minute when we talk about remuneration. This compares to just over 1 billion, as you know, we generated in 2023 on a consolidated basis. So this is a very, very important target for us, and it's established on the back of solid cash conversion across the business lines, as has been explained, and I will get into more detail in a minute. Lastly, in terms of shareholder remuneration, we are targeting to deliver over 2 billion of cumulative dividends to ACS shareholders and HOCHTIEF minorities in the period. So this is a 2 billion consolidated number. It incorporates both ACS and HOCHTIEF minorities. And that is expected to be above 2 billion and includes an intention to increment the dividend for ACS shareholders through the period. Now, this is the financial roadmap we've established to achieve these targets. You've heard a lot from the business directly, But the question is, how does all that come together in terms of consolidated financials for us to deliver on the targets we've just gone through, right? So if I go, horizontally, let's say, talking first about revenue growth, as I said, 9% CAGR, 6% like-for-like, without the consolidation of these, driven by Turner's growth in the US, strong growth prospects in the US, and the expansion, the organic expansion in Europe, and advanced services in supply chain, engineering, etc., and growth in the new growth sectors. From CIMIC's perspective, similar. CIMIC has been experiencing, in 2023, experienced very solid revenue growth. The expectation is that will continue. We will be sharing numbers about this as we report going forward. And you will see the developments, a stronger growth as in the same case as Turner in the high growth areas with higher value added, and consolidated position on the E&C part of the business that lies within CIMIC. In terms of infrastructure, what we've been doing in the past, we will look for highly synergetic in terms of revenue investments, profitable investments standalone, but also generating revenue for the rest of the business, and that will contribute growth to the revenue line. And in terms of engineering and construction, you've been seeing through the day plenty of examples of collaboration between the different group companies and how that will support as well growth of the E&C business in the period. In terms of profitability or margins of the business, this is a key focus for us in the period, as it cannot be in any other way. But we have, thanks to that operational integration, we've got a lot of opportunity in this front. So part of that is going to come from the business mix, higher percentage of revenues in the different businesses in higher value add segments, as you've been hearing from the business, plus also realizing more efficiencies across every business line and as an integrated group, generating more efficiencies from the fact that we are more integrated and we deepen in that integration going forward. So we expect to obtain significant value from that, which I've put at the bottom as well as integration efficiencies. In terms of cash flow generation, again, just to reinstate the target, 3.3 to 4 billion at a consolidated level of net operating cash flow. That's the target for the period, for the 3-year period. Sustained, as I said, by very strong cash flow performance by the different parts of the business. Turner, you've heard about their delivery to date in that respect, and that's the expectation going forward. It's a CapEx-light business, it's a working capital generating business, positive working capital generating business generally, so very strong cash conversion expected from Turner. Same with CIMIC, with some level of completion in the process that we know we are in for some time in terms of unwinding the working capital that comes with a changing model to lower risk contractual structures, but a long-term stable cash flow as we complete that de-risking process we are in. Abertis, you've heard as well about Abertis. We rely on a stable cash flow generation, stable dividend of 600 million per annum, plus the dividends that are generated by the rest of the assets, concessional assets or PPP assets we own around the business and all the investment we're diverting there. And lastly, from E&C, a stable cash flow generation as we complete the remaining working capital unwind linked to the change in the contractual model and the lower risk models. So let's go through the net operating cash flow, how we're going to deploy that capital through the 2024 to 2026 period. As I said, we expect the business to generate on an organic basis, based on the current market position and based on the current organic growth prospects, we expect to generate in the period 3.3 to 4 billion. Again, 4 billion, remember, includes TIS, consolidation, 3.3 doesn't. So first of all, first allocation of that is shareholder remuneration. as I said, that 2 billion block includes HOCHTIEF minorities as well, not just ACS shareholders. And it assumes our intention to increase the dividend per share through the period. That means we are left with 1.3 or up to 2 billion total firepower from the business cash flow generation, of which we have already invested 650 million in Abertis earlier this year, and we are allocating 200 million for the potential acquisition of the 10% of TIS. So with all of that, we're still left with 1.2 for the period to direct to our investments, and I'll get in a minute in how we make the decisions through the process in terms of capital allocation, plus between 2 and 3 billion of cash flow coming from divestments of non-core assets, which I'll talk to in a minute. So all of that will be allocated in a flexible way, in the sense of, in terms of timing and in terms of complying with our financial policy, which is basically shareholder remuneration, as explained, with the 2 euros per share and the intention to grow over the period, and protecting our strong credit profile and our investment grade rating profile. So these are the opportunities we will continue to look into in order to deploy the capital going forward. We are adopting, and Juan mentioned it as well, we have adopted a very strong and robust flexible capital allocation policy and process to decide on all these investments. But essentially, in terms of what they are, you can see on the left side, value accretive strategic M&A. There's plenty of examples we've done and we will continue to look at in terms of bolt-on acquisitions to enhance engineering capabilities for businesses that once come into the ACS world, let's say, or portfolio, generate a lot of synergy in terms of revenue growth and value, and that will add to the long-term value of the company. The support to Turner's expansion into Europe or any other strategic investments we analyze as we go. In terms of brownfield infrastructure acquisitions, Abertis is an amazing growth platform, as you have heard, and we will continue to analyze opportunities. There's a lot of opportunities, as Jose Aljaro explained, in the pipeline. We will continue to look into that, and that's certainly an area of interest for us to deploy capital. And lastly, in terms of equity investments, you've heard from Nuria the amount of opportunity we've got across the group globally in this area, both in core infrastructure and more traditional markets, but also in the new vectors of growth. And we are already deploying capital like skyports or glideways, and we're already deploying capital in these areas that will contribute to the long-term value of the business. To the long-term value of the business. To the long-term value of the business. Strict guidelines for investment. We will look for flexible and liquid investments as we go. We will look for high synergy potential of every investment we put money into, in addition to obviously the financial standalone attractiveness of the investment, and protect the investment grade rating of the group together with the shareholder remuneration. And these are essentially a summary of the guardrails of our financial policy, which will cover the capital allocation policy in the period, and as we go, how we make decisions. And that's why I referred earlier flexible allocation through the period. First of all, shareholder remuneration with an intention to increase the 2 euros per share in the period. The maintenance of our investment grade rating and the group companies that also have an investment grade rating, and within a well-managed and sound debt structure management going forward, based on the same principles we've been doing traditionally. So conservative liquidity and comfortable liquidity levels, limited refinancing risk and long-term maturities for the debt, finance cost management of the debt structure, and a good diversification between funding sources, between capital markets, etc. You can see there on the slide some of the key the key metrics in this respect as of December 23 for the group, which shows a sound position in that respect. So key takeaways from my perspective from this financial review, before I turn to Juan for his closing remarks. First of all, the new reporting structure, it's very significant. It's gonna it's gonna allow you to see the business how we see it internally and aligned to our operations and to our strategic decisions. We've got a strong business plan, organic business plan that is able to generate, based on the current market position, all the growth opportunities we've been talking about, the cash management and the cash delivery is able to generate between 3.3 and 4 billion of cash across the group that we will use to provide shareholder remuneration and long-term growth of the company for the benefit of shareholders. And that will be driven by a strong and consistent delivery by the different business lines, big contribution by integrated solutions, and stable contribution in the period of cash and longer-term growth opportunities for infrastructure. And just to state the last, all that capital allocation, as I said, will be driven to deliver shareholder remuneration, there is an intention to direct investment to equity investments to deliver long-term value together with the attractive shareholder remuneration while protecting our credit profile and our investment grade rating. So thank you very much. Thank you very much for listening for me today. Thank you.
Okay, so we reached the end of our Capital Markets Day today. If you remember, back in 2022, a few of us, we got together, and we were talking about ACS at the time. And a few of you asked me about the vision for ACS. And we started talking about our biggest strength, which was our geographical positioning throughout the different markets, and that was going to be key to address and approach what was coming. And we spoke about a few things. We spoke about different sectors. We touched on data centers. We went through defense, battery fabs, and we're going through all of that. At that time, there were a few questions about, it's a good vision, and how you're planning to move it forward. Because right now, ACS, after the sell down of ACS Industrial, is a civil and building contractor. And at that point, we went through how we're planning to implement it. Today, we're not giving a vision. Today, we have explained a reality. We have gone through the current valuation. 120 years of history of Turner is not wrong. We just gave visibility. And at Abertis, unfortunately, we haven't been able to give the visibility before for different reasons. But we have provided with the modeling. The net debt, the assets, the dividends, all that comes out of the model. And when it comes to CIMIC, if you go through each one of the organizations within CIMIC, all of them are very stable, long-term business, working in collaborative jobs, such as Sedgman, UGL, this Leighton Asia. History doesn't lie, and that's why we are so obsessed to de-risk our business model. And that's why in that civil component that we still have, we want to make sure that we avoid some of the mistakes of the past, when a lot of the construction industry was taking unnecessary risk. And ever since the last 2 years, we've been communicating the percentage that we've been achieving in terms of de-risking our backlog. Having said that, you are not going to see any surprise. We believe that we're very close to continue the de-risking, and there's probably 2 years from now to achieve that, an important part of 100% of our backlog. But until then, we will not see any surprise. We're very comfortable with our backlog, and we're very comfortable with the way we're doing things. I won't go through all the messages that you've been hearing today, because we would need another 5 hours. But there's a few important ones that I think are worth to emphasize. First one, when it comes to Turner, not just the 1.7 billion dividends delivered since 2017, but that 10% annual growth in the PBT, 8% backlog, 6% revenues since 2017, and 100% conversion rate. The reason why we're bringing Turner into Europe is because the clients are asking for it. Those clients are letting us know where do they want Turner to be positioned, which companies they want us to approach, and how they want us to continue doing business. Turner is around 18 billion revenues in the US. But right now, they are just started to look at Europe. And there's already 2 billion in opportunities that will be materialized very soon. And the pipeline is around the 20 billion. So there's a huge growth opportunity for Turner in backlog. And we also went through the yields before. Margins not just finishing 2.6% at the end of 2023 on a PBT basis, but they will continue growing above the 3.5 by 2026. There's a lot of value. When it comes to CIMIC, CIMIC is a huge platform, and in the same way that Turner is going to Europe and to Asia, CIMIC is coming to Europe and into North America. The level of knowledge in the engineering associated to the industrial, renewables, energy transition, critical minerals that CIMIC has is unprecedented. And we're going to use all that knowledge to do exactly the same thing that we've been doing from Turner perspective, but with CIMIC. And we are very, very encouraged about some of the opportunities that the market is offering us in those sectors. Abertis, you have the model. Please ask any questions you might have. It was very important for us to show how the net debt profile was evolving and unwinding over the years, because there was a lot of questions about it. 25 billion, half of that corporate debt, how are you planning to repay? It pays by itself. It's a matter of time. It's linked to projects. It's linked to assets. It's not differentiated between corporate assets. Everything is part of the same thing. It's just the way that debt is managed to achieve more efficiencies in cost. But it's linked to projects, and we are very comfortable with the 600 million dividend in perpetuity growing after 2038. But more importantly, what you saw today on Abertis doesn't include extensions, doesn't include the money. And you also saw that we do have firepower to support that potential M&A at Abertis. It was very difficult to see M&A opportunities for the last 5 years. Pension funds, very, very, very competitive. And it was quite or almost impossible to see one brownfield transactions in the last 5 years. We're being so much more conservative than that. But we will be talking and following up on those opportunities and how they materialize over time. Same thing with the renewables, same thing with sustainable mobility, and of course, we did not include on purpose the opportunities associated to hydrogen or to critical minerals, because we don't want to mislead or believe that we're just being aggressive and talking about blue sky. And then engineering and construction. Engineering and construction, as I said before, it's our DNA. And the investment in traditional transportation, construction, is just going to go increasing and increasing and increasing. So that increase is a big opportunity for us. It's just that we want to do it right this time. And where's the opportunity? That is very difficult to find nowadays a pure civil project. Because that kind of commodity applies to a small projects, but not to the big projects. Every big project nowadays, as I said before, has a component of energy, has an associated data center, most likely has standalone 5G associated because everything is smart these days. And it's probably in a difficult part of the world, requiring a lot of people. And yes, labor is one of the big challenges these days, being able to bring skilled labor. But at the same time, it's one of our biggest strengths, to be able to mobilize people. We are very proud this year that for the first time, ACS Group has become part of the Forbes list of the employer of choice, the best place to work. But we're very proud that it's not just that we have become part of that selected list, is that we have become the first company in Spain, above all banks, oil and gas companies, and telecom companies, in the ranking in Spain, and in a very good position internationally. So that says a lot about our values, about what we stand for, about how we're pursuing pretty much the ESG component of our plan in a rigorous manner. And that also follows the fact that CIMIC and Turner has been, for many years, being the employer of choice of the people in those areas. So ACS is a reflection of our companies, and our companies are a reflection of ACS. So I want to finish with the 3 pillars, because that's the way I started: the risk in our balance sheet, growing our backlog in all these new segments, making sure that we increase our yield and our margins, and of course, taking the opportunity that all these new segments give us from an equity perspective. So I'm going to turn over right now to the team so we can go through all your questions, but I truly appreciate your time today, and of course, we will be following up with you through all the results this year. So I'm going to invite the entire team to join.
Enhorabuena.
Questions?
Hello, Luis Prieto from Kepler. Thank you very much. I have a bit of information overload, but thanks a lot. Really appreciate what you've done. Quite impressive. I had a couple of questions. I don't want to monopolize. The first one is regarding capital allocation. You described very clearly the numbers where everything comes from, what you want to invest in, but there's obviously a moving part there, which is if you're forced, sorry for the expression, but if you have to pay more for a larger stake in T's beyond the 10%, obviously the result gets affected. So my question is, what sort of leverage could we take into account, if any, on top of what you described in order to compensate for something like T's, for example? And the second one is, you've talked about Turner, you've isolated it in your future reporting, which is great, but how much is that business worth? I would like to know who you think your competitors are and what's the right multiple, EV/EBITDA, if you could provide it, please. Thank you.
So let me start, Luis, going through some of that, and then I will turn over to Emilio. As you see on the screen, this acquisition, I mean, the first 10%, I'm sorry, it's not in the screen, but let me take you through it. If you remember, out of the firepower we had, it was net operating cash flow 3.3 to 4 billion, and out of that, our intention was to use approximately 2 billion for shareholders' remuneration. There was allocated 200 million for the Tissue acquisition, 650 million for Abertis, and then in total, including non-core asset divestments, it was going up to the 2.5 to 4.2. The 40% acquisition of this most likely will happen by the end of 26, and the revenues or the cash going out at the beginning of 27, right? That's what we haven't included. So you would need to add another, by 2027, probably 1.5 billion of firepower into that, right? If you look at our profile, we are at 1 billion, 1.5 billion, less capex, 1 billion, 500 million shareholders, 500 million firepower for investments. We're going to grow that. That's why we get into a 3.3 to 4 cumulative by the end of 26. So by 27, we should expect that 1 billion moving to 1.5. Now, even if for whatever reason that put was exercised before, which I guess that was your question, I mean, we still have from 2.5 to 4.2, I mean, available to cover a lot of that, or 1.2, the remaining firepower, if you deduct that. So we are very comfortable that we're going to be able to continue using, I mean, we have enough funds for dealing with everything we have.
Yeah, I would add, if that put was exercised, we would bring all that cash flow with it, so it's financeable. There's liquidity at CIMIC to accomplish that, so there wouldn't be a problem in that sense, on the contrary. And on the other hand, from a rating perspective, that's already factored in. So from a rating perspective, it adds on the subjective side, or the more qualitative analysis, it's positive in terms of business diversification, and in terms of credit metrics, is neutral, essentially. So from that perspective, it's within the financial policy, etc. If it comes early, at the put price, it's accretive to these numbers, because we would be saving minorities going forward, which is not factored in.
And the second question about Turner. So we wanted to put a spotlight in Turner because we see real chances for Turner to grow into the future, right? Above and a larger scale of what has been the past. And that's why it's so important for us to make sure that everyone is looking at Turner and that evolution in margins, in revenues, and in segments, especially now that the US is booming, and especially right now that we go to Europe. Who are the competitors of Turner? Jacobs, AECOM, Bechtel, KBR. Which are the multipliers? I mean, Jacobs has gone from, depending on the time, from 12 to 16. Bechtel is private. But those multipliers of EBITDAs are very well known in the market. And they are similar companies. The more Turner continue evolving into high-tech areas, industrial areas, which it will, the more we will be able to achieve those targets.
Thank you so much. This is Marcin Watchtal from Bank of America. Firstly, on your disposals of non-core assets, you indicated between 2 and 3 billion Can you provide an update? We've been obviously reading in the press about Clece and energy assets, but are these transactions moving in the right direction? And maybe second question, if I may, you gave helpfully guidance for net profit for the group for 2026. Is it fair to say that Turner is the largest contributor to growth? That would be the one with the highest growth. What are the other relevant contributors in terms of segments for net profit growth?
Starting with the second one, Turner for sure is a big contributor, but we also believe that E&C has a lot of potential, right? Especially when it comes to North American market, and as we move into these collaborative contracts, we see a lot of potential in the business plans, growth and margin. And that was, this is one of our pleasant surprises, that we are in the right direction when doing E&C. In the case of CIMIC, we see a lot of potential, but probably we see the potential of CIMIC beyond 2026, right? I mean, because we need to go back to the transaction we did with Elliott back in 2020. At that stage, TIS, for example, did not have any debt. And post-transaction, we raised 1.6 billion, we put in debt at a 44 million interest cost per year. Nowadays, that interest cost is 220 million. And TIS is dealing with 220 million load in its numbers. UGL and Leighton Asia are the ones that are going to grow significantly, and the potential is unlimited. But also we've been that for a few years, because Leighton Asia has gone from a 50% high-tech or advanced technology, 50% civil, to a pure advanced technology, high-tech markets digital. We have seen a growth, but an unwinding at the same time, right? So we will see a little bit of that before Leighton Asia will start growing even above what it used to be. And we're very comfortable that will happen 26 onwards. So we do see a lot of potential with CIMIC. When it comes to ACS infrastructure, it's true that that's not so much embedded in the PBTs and EBITDAs and P&L, but from a value perspective, that's probably one of the jewels of the crown, right? And that's the one that will be more, doing more follow-up as we go. And the other question, Marcin, sorry, the other question was about...
Apologies, I was asking about disposals of non-core assets, Clece and energy.
So those, the ones we always include in the list are Clece and industrial assets that Vinci did not purchase when taking ACS Industrial. And those are the ones that, the reason why they did not buy them is that because they were not completed or there were any kind of defect that had to be corrected, etc. So we believe that most of those assets will be disposed by 2025, and Clece, it's under analysis right now.
Thank you, Graham Hunt from Jefferies. Just two questions from me. First of all, on the SH288, maybe if you just comment on how the developments there, if they've changed the way you think about the US express lane market at all, and the pipeline that you see there. And then, second question, you spoke about extensions being one of the most important opportunities you see in Abertis. Could you just talk about what stands in your way, sort of getting those extensions, and if you could give any color in terms of what you're expecting in the midterm, that'd be helpful. Thanks.
So starting with 288, it hasn't changed our mind. We still believe that the US market is a great market. What Texas has done is just looking at the contract, analyzing the possibility to take the asset at a lower cost. But it's true that it's a very specific clause that Texas has been putting in their CDAs or concession agreements for a number of years. The rest of the managed lanes we're pursuing, and you saw the program and the examples that Nuria gave, is significant, is huge, and do not have that clause. Termination for convenience, going forward, we want to make sure that it's for market value at the time of termination. So from that perspective, we are comfortable and it doesn't change. Regarding the potential extensions of Abertis, and Pepe can comment more on that, I will turn over to you, Pepe, in a minute. But those are the biggest opportunities because do not require equity, right? And traditionally, that has always been, and that's why Abertis put so much emphasis in talking about the past when explaining the future, because that has always been the way for government to increase CapEx, increase investments out of their balance sheet, and pretty much implementing instantly without going from 1 year to 2 year tender process. And what we're going to find is a situation in many, many markets that there's a real need for infrastructure, especially in South America, but also in Europe. And most of the clients, when they are facing that situation, having Abertis or any other operator, owning assets and being able to pretty much run all those CapEx extensions through the operator is the best, more efficient, cheaper, fastest way to put people to work.
Okay, clearly this is one of the strengths of Abertis. All the management team is fully oriented to identify opportunities to open negotiation with the different grantors or governments, try to generate extra value in our assets. As I said before, you saw in the presentation some example, but having said that, we have other in the pipeline. I said we have under negotiation right now with the Brazilian government the possibility to extend some of the federal concessions. Today we manage 5. We have presented ideas and projects to extend up to 15 extra years those concessions. I mean, today we have only 2 in the second phase. I mean, we have timing to negotiate these 2 concessions. The other 3 is standby, but that is a great possibility to improve and to generate additional value. Always is a win-win with the administration, but clearly we know the asset. I mean, the risk is limited. We have the back office, we have everything. I mean, in many cases, it's a way to invest extra CapEx and in exchange of that, extend the concession. There is other formulas. In other formulas, we change the tariff scheme, for instance. On that case, we modify, we reduce the tariff, and in exchange of that, we extend the life of the concession. I mean, that is different mechanism. Let me to give you some feedback about other opportunities. We have some ideas on mind to renegotiate improvement in our road in Mexico, for instance. But it's not the right timing today. There is election in June. We have to wait. The new minister at that time, we will approach them and we will start to propose ideas. So the ideas is to improve capacity, to improve safety. For instance, we are very sensitive to safety. That different cases. In some cases, is some politician in one region need to do ring road, for instance. I mean, we are very, very focused on that. Sorry to extend in my answer, but I give you other examples. For instance, in Puerto Rico, recently we won a tender and we bought 4 new concessions. On that case, the tender process was launched for 40 years. And the maximum length of the concession could be 50. We pushed the governor for only 40 and not 50. Why? Because we identified in the due diligence process some actions, some ideas to improve later and to go in this trade-off. Okay, governor, if we do this and this improvement, we will reduce some traffic jam here, we are going to improve safety in this area, and in exchange of that, we will ask the 10 extra years. I mean, we are always thinking in this type of things.
Thank you. Maybe I'll take Dario Maglione from BNP Paribas Exane.
Thanks for the presentations. 3 questions for me. One on Abertis. In which scenario do you expect an equity injection in 2024? And what has been the feedback from the rating agencies on the business plan that you have presented today? Second question on the working capital outflow that has been going on as you transition to lower risk contracts. When do you expect that outflow to stop? And third question on Iridium, the existing assets. You know, often we look just at the book value, because there are so many of them. But where do you think, you know, there is a lot of upside potentially compared, you know, the book value and the actual value of the asset? Thanks.
Okay, so I will turn over to each one of you, but in general, I mean, I guess that the last question on the 2.7 billion for market value on the assets, is there, as they get mature, opportunities for recycling equity? Yes, there is. We haven't considered it, but there is, right? In case of Abertis, so we're working with the rating agencies, obviously, presenting all the plans. And of course, the rating agencies, one of the things that I believe they are comfortable is first our commitment always to keep the investment grade of Abertis. And in second instance, that they see that the shareholders, we are pretty much committed to Abertis, with equity, with the negotiations of extensions, etc. So all of that is very, very powerful. But I will turn over to Emilia, Nuria, and Pepe to...
I think you've summed it up. In terms of Iridium, I think in terms of our assets, we have a number of assets where we have opportunities sometimes for refinancings, and so we can get value there. We have, as I said, a good mix of portfolio in terms of availability. So sometimes there's more limited abilities for a huge upside there other than in exits. So we look at strategic exits where it relates to that. And then we have a good demand risk. So I think, I mean, really the value that we're able to bring and draw forward is on managing the financing and optimizing financings, as well as where it makes sense doing equity rotation.
Okay, only to add regarding rating, we have a monthly contact with the rating agencies, and before to present a binding offer, we submit to the S&P what would be the outcome if we success in this process. That gives us a guarantee that we are everything in line with our commitment. Our commitment is to maintain the stable outlook in the BBB-. I mean, we think this is the more optimal notation or rating for our company.
And to the last point on the working capital, probably the answer is 24 and a little bit in 25. But overall, we are not concerned about an overall unwinding. If you will see that certain companies have an unwinding as we migrate and de-risk the organizations, but overall you won't see an impact in the overall working capital because some companies are growing significantly and there will be an unwinding. So, but if you were to isolate those companies, more impact in 24, a little bit in 25.
Hi, thank you for taking my questions. João Safara from Santander. I have 2 questions, and both of them are, well, the first one on the cash inflows and the second one on the cash outflows. On the cash inflows, just to understand, again, going back to the potential divestments, if this includes the SH288 or not, has anything changed? Do you take that into account? That potentially, if there is obviously a renegotiation, it would be more difficult for you to sell this asset than before, just to have an idea if you add that into consideration. And then the second one on the use of the 1.3 billion euros of equity investment. What I would like to understand, and if you could give us more color here on basically on what is the equity committed as of today for these investments. So we know there's a 3-year period, so I'd like to understand more or less this 1.3 billion euros, how much is today already committed to be invested?
Okay. So starting with the first one, the bad part of the 288 is that obviously we lose an important asset. But the 288 dividends were very much back-ended, with most of it post-2050. So in short term, and I don't want to give the impression that it's a good thing, the termination for convenience of the 288, because it's not. But in the short term, we are getting an inflow of 1.2 billion. 44% comes directly to Iridium, 50% of this 56% through Abertis, right? So we do have an input, we do have an injection of equity in the short term. In terms of a potential sell-down of 288, we would have waited maybe 2 or 3 years to get it, and we would have been able to maximize that. How much more? I'm not sure, right? So we would probably, the divestment wouldn't have happened at Abertis level, would have happened at the Iridium level, and instead of getting the 500 million, we would have been able to get twice that amount, more or less, in that sense. And then, Nuri, if you really want to go through the, he was asking about the 1.3 billion, how much of that is already available? I mean, of the total firepower, we were talking about the 1.3 billion investment for Greenfield, right? And that one, more or less, when you look at the page of investments and you see how much we have for data centers, how much we do have for renewables, how much we have for the different projects, that 1.3 billion is going to be allocated to that. There's an important portion potentially of managed lanes in the US out of the 1.3 from now to 2026. There's an important part that goes to data centers, and we have 3 data centers in mind right now. There's also opportunities already identified through sustainable mobility, especially electric chargers and the ones coming from skyports and glideways that we explained before. And we do have the ones for renewables in Australia, right? And that will be from now to, and it's an important part from now to 26. The firepower we have above that, which is significantly, because we have another 2 to 3 billion by heart, that's the one that we need to decide. How much of that 1.2 to 2.93 billion we want to allocate to Abertis, how much to new infra projects associated to ACS infrastructure, and how much to M&A. Because when we were talking about Turner coming to Europe, or CIMIC going to Europe or North America, there's an important piece of engineering that we would like to acquire and make analytic capabilities on the ground.
Hello, Augustin Sand from Stifel. I've only got one question. In your 2030 vision slides, you were talking about the simplification of the group, and I imagine this refers to your structure. So I was wondering, how do you think about your HOCHTIEF stake in that context?
So first of all, operationally speaking, we're very comfortable with the way we are, right? And there were 2 question marks in our business plan, and for the last 2 years, a lot of questions in this regard, saying, how are you going to simplify ACS? Because ACS is very complex, lots of brands and minority interest. Today, we wanted to make sure that everyone sees ACS in the same way we see it, which is, first, having different brands is a strength, not a weakness, and 2, operationally speaking, we access all of that. Because between ACS and HOCHTIEF, we are pretty much managing the group in a unique and consistent way. Yes, we need to make sure that we protect the minorities of HOCHTIEF, and we will always do that in everything we do. That's number 1 rule when managing ACS and HOCHTIEF. So what about the potential acquisition of HOCHTIEF, which is your main question? At this stage, it's not in our agenda, but of course, always happy to be opportunistic when it comes to capital allocation. What we don't want to do is to distract ourselves from all the opportunities we have described today by focusing on trying to consolidate our group internally, because we don't need it. Right? It's a good financial investment, yes. Doesn't give us more EBITDA, but it gives us more impact and dividends, of course. The math is direct. But we believe that we can generate much more value by pursuing other capital allocation structures. There was a question at the end.
So, good afternoon, Nicholas Morat from Morgan Stanley. Quite a few, but I'll go straight to the point. On Turner, there's a lot of froth on data centers. Can you help us a little bit, really, in a simple way, frame the opportunity? Today you're doing $3 billion revenue in data centers. Where can it go? How much is this boosting margin? Just to help us basically salivate on the opportunity. That would be the first question. Then on Turner again, you're talking about high tech. There's also the low tech business. How is that doing? Is it still stuck in a 1 to 2% EBIT margin range? And how much of a, let's say, a cannonball is it to the overall progression of margin? And last on simplification and streamlining, thanks for the new split, but I don't personally, I'm not quite sure we're streamlining much. Integrated services still has CPB contractors, for example. You're going to add contract mining. That's a bit disconcerting for a fair amount of investors, especially with an ESG focus. Can we even simplify further? Why not just group Turner and UGL, for example, which are high margin, very high multiple businesses, and strip out CPB? So I'm not entirely sure we're actually simplifying really that much today, and the market's going to be able to recognize and value the assets as much as one could hope.
You want to start with Turner, Peter?
Sure. Thank you very much for your question. I think that the $3 billion that we have today can immediately go to $5 billion in the next 2 quarters because of the race to AI by the 5 hyperscalers. And those opportunities for us are going to become more and more prevalent because there are only a limited amount of competitors that can work in that data center market. So we are really waiting for the, I'd say, the oil bust to really give us more opportunities. In addition to that, those competitors have small scale. In other words, regional. They're more regional, where we have larger scale in the country today. The second part of your question is on the buildup of margins. What we're finding is that we are able to price the value that we bring as integrated solutions to these projects, like Source Blue and self-performing. If you think of a data center, you think of a server, that the servers on top of servers on top of servers, and then that's a warm layer, and then there's a cool layer next to it, and they have to be mixed together. They're partitioned off. So what we're doing is we're self-performing all of those partitions so that we are doing more of our self-perform work in those data centers. That's price to value. That's increasing the margin on those particular projects. On the EV battery space, in one project, we are building 1/2 of all the clean rooms self-perform. That's another opportunity to price the value because we're increasing the margins. And then the last point I wanted to make, the competitors in the data center space are not necessarily the competitors in the EV battery space, and we are in both. So we are going to take advantage of the price to value and also take advantage of the opportunity that if those opportunities come out, our scale will be able to accommodate those clients and building and participate in the race to AI.
And on the second question, I will go through it right now. So you're right, and let me answer because your question has two different angles, from an ESG perspective, from a financial perspective. Let me start with the financial perspective. You're right, CPB should be in the EMC instead of the CIMIC, but it was very difficult to reorganize everything to change and to move CPB out of the reporting. So we will provide that adjustment whenever we're talking one-on-one. It will be easy when it comes to evaluation, right? The reason why we believe that this should be, and so is Sedgman, is because the world of natural resources is different from the world of just coal. And 4 or 5 years ago, Thies and Sedgman were mainly coal-oriented, mining and processing engineering firms. But they've been moving away from that. Rare earth are highly engineering, complex projects. So is lithium, so is nickel, so is iron ore, so is copper, magnetite, vanadium. It's not coal. It's a processing coal plant is crushing the mineral. Very different from lithium, which you have a variety of options. And the same thing from an operation perspective. Even more when you get underground, and part of the operation, it's underground in highly engineered environments, right? But at the same time, both of them share exactly the same approach to business than Turner when it comes to risk and to cash flows and to certainty, right? And both of them are in the long term. And at the same time, when we were talking about Turner, one of the things that we love about Turner, right? We love everything about Turner, as you can imagine, but one of the things that we like is that relationship with the clients that they do have is being very useful for Leighton Asia. It's been very useful for UGL, it's been very useful for Dragados and for Hochtief, and all of that is being managed by Turner. Even Source Blue, it's going to become a more centralized platform. Open parentheses, 2 years ago, we were talking about having a centralized logistics supply chain platform, right? And we were talking about the potential and the need to have that. Well, in 2 years, that platform has revenues above 1 billion and 6% margin. It's unlimited, the potential. So I close parentheses. Getting back to Asia, the same thing happens with this and with Sedgman. Rio Tinto is all over the world, and it's asking Sedgman and Thies to follow them. So is Glencore, BHP, FMG, right? In the same way that certain clients are asking Turner to go out, some more clients are asking Thies and Sedgman to go out. So those firms are integrated solutions because they share risk profiles of contracts. They share engineering complex projects. They share a lot of those common features. So the only one that we see out is CPB, and we will adjust, and we will be able when it comes to valuation. The other part of your question was from my ESG perspective. We are making a huge effort to diversify Sedgman and Thies out of coal. As I said, Sedgman is almost there, right? Because their engineering projects have a lifespan of 1 to 2 years, so basically it's very easy. And through all the acquisitions of Novapro, Minsol, Onyx, and Prudentia, it's almost done. In the case of Thies, it's more complex because it's huge, right? But when you look at where Thies used to be in thermal coal 4 years ago and where it is right now, in the 30-something%, is quite remarkable. And at the same time, we are transitioning all the fleet to go from diesel to dual fuel, and that overhaul is happening in Indonesia with a special hub that was established by Thies, and on top of that, they did jump into the rehabilitation of mines. So I want to believe that by 26, 27, 28, as Michael was explaining, it will be the most sustainable and friendly miner in the world. And we believe that we can achieve that.
If I may add something, Nicolas, maybe on the practicalities of the financial reporting. Obviously, that's a situation you always have to find a bit of a balance between management and pure description of the activity, and CIMIC is a diversified platform in itself, as was explained during the presentation. The important point for you is you're going to get reporting quarterly from CIMIC with breakdown of the different activities in a similar format. So you will be able to identify the E&C business from CPB in terms of financial KPIs. We are going to report, as I said, fair value and book value of the investments from Pacific, for example, within the infrastructure segment as well, not from P&L, etc., but from an investment perspective. So we've thought of those mitigants to go a step further to simplify the understanding of the group.
That's right. And furthermore, when Luis was asking who are the competitors of Turner, and I was going through all of them, those competitors have a big component of civil as well. I mean, the fact that you are integrated solutions, that doesn't mean that you don't have a component of civil. It's more about the percentages of each one of the segments in your overall backlog. But anyway, that's also...
If I'm a bit sarcastic, just in terms of again, market perception, you're just adding 10 times EV/EBIT businesses to a thesis where peers are valued at 4. I mean, it's very simplistically, and again, we're in an oversimplifying world, but you're adding great businesses, my personal opinion, decent value, margin expansion, DCs, EV battery, to the old world, and again, Australian peers trade on 4 times EV. But we leave it there.
Let me make a comment before you leave it there. You're right. We are not, in our valuation, we're not putting CIMIC at the same multiplier of Turner, because exactly what you're saying. So it's not that we are closing our eyes to that. I mean, we're not evaluating CIMIC as if it was 100% multiplier of a Turner. We're just going through what's evaluation of this, separated from CPB, separated from UGL, etc., and putting all of that, discounting debt plus headquarters, and coming out with evaluation, following what you're saying.
If I may, last question on Turner. I think we talked with Juan a few times on one of the key peers, so Excite, the German private company, which does more fabs, so semis. These guys do 6-7% EBIT margin. They do so because they're more integrated. They've gone up the value chain. Do you need, as Turner, to do more M&A, maybe especially in Europe, to go up the value chain, be much more integrated? That's the main question. And the last one, we've talked distribution, data centers. The other parts of the businesses for 12, 18 months have racked up fewer orders. Think about EV batteries. You don't win an order every year. Biopharma. When can we expect these parts of the businesses also to join, let's say, the DC revolution?
You want to answer? So starting with the first one, we don't need any external company to bring Turner into Europe. Turner has all the capabilities in data centers, has capabilities in battery fabs, so in semiconductors, biopharma, etc. And in fact, I mean, in all the categories that I just mentioned, if it's not number 1, it's 2 or 3 in the US. However, if we want to accelerate the presence of Turner in Europe, it's convenient to do M&A. So we are analyzing M&A seriously in Europe to accelerate the presence of Turner in Europe. When we analyze M&A, we do a couple of things. The first one is the mechanical capabilities on the ground. So that's the one that you truly accelerate by going through M&A. And the other one is we'll continue doing bolt-on acquisitions when it comes to engineering. What's the latest? Because it's very difficult to generate good engineering ideas organically. We do, but it's better to grow that. And on the second question, I'm not sure if I understood the question, because when, I mean, battery fabs, biopharma, semiconductors, all of that are already part of the portfolio of Turner. We will see much more growth in the future on those ones. Data centers is going like this, but the rest of the segments will continue growing significantly. Peter, I'm not sure you want to add.
There's no question about it. I think that, again, the race to AI, the race to sustain our planet through, in the United States, we're going through a modern-day industrial revolution. The factories that are being built in the United States today are for sustainable technology, and advanced technology is quite extensive. And we believe that that market is going to stay for the foreseeable future, even in an election year. we believe it's going to stay.
Good afternoon. This is Fernando Lafuente from Alantra. Thank you so much for the presentation. 3 quick questions for me, please. The first one is on cost cutting. You've talked about the margin of each of the divisions, and does this new integrated way of looking at the group bring some cost cutting? And if so, can you quantify it in this growth that you are targeting for 2026? The second one is on the dividend. If I understood you correctly, Emilio, the underlying, let's say, guidance on dividends, although it's on a cumulative basis, it's going from the 2 euros that you paid last year up, whatever. So my question is if there is any kind of a strategy in terms of dividends or policy behind, in terms of payout or annual growth, kind of to extend that going forward. No? And the third one is on Turner. I really appreciate all the information that you have given us. My question is, what are the barriers of entry for the same as you are coming to Europe, and it seems that it's going to be easy for you. What are the key points for you to come to Europe and being so easy, and don't misunderstand me, no? For easy. And what are the barriers of entry for any guy that wants to go to the US? Thank you so much.
I want to go through the 2 first. Yeah, so as I explained, in terms of the dividend policy, we've got a target to increase the dividend per share through the period. Obviously, when you look at the target we've put in terms of NPAT, you see it's an 851 billion for 2026. There's obviously a lot of growth coming through the period in terms of revenue growth, in terms of profitability, cash generation, etc. So it's a wide range in terms of setting up a specific policy right now on how that's going to evolve over time, but it's certainly a strong commitment to increase that over time and keep an attractive payout ratio through the period.
And to add to that, I mean, it's a balance, right? We are always talking about yield growth. And from our perspective, from a management perspective, our obligation is to find that right balance, okay? If we were to cut dividend, probably wouldn't be here right now, but we would create numerous opportunities to grow, but vice versa. I mean, so it's very important to keep that. The good thing is that we have that balance, right? It's very difficult to find. I mean, most of the big companies with huge growth potential have no yields, and vice versa. The ones with high yields have no growth, right? So we have a very good balance. And when it comes to the synergies, we are not including synergies when it comes, or big synergies when it comes to cost, etc. Do we have those? Yeah, of course, right? Are we aware? Yeah. Are we going to expect synergies and reduction in cost in the near future? Yes. But I mean, obviously those operational efficiencies are always very sensitive. And regarding Turner, you want to?
Yeah, I would say that we're in a very lucky position because 3 of the hyperscalers have asked us to go to Europe. Iridium has asked us to go to Europe. So we are teaming up with Dragados and teaming up with Hochtief Building, and we want to take them as a true opportunity. And we believe that those opportunities are going to continue wherever there's a pad and there's power for a data center. I know that at CIMIC in Leighton Asia, the two hyperscalers are going directly to Leighton Asia, and they know they're from an ACS global company. So it's becoming a great opportunity, and it's been it's been very, very helpful having the hyperscalers know that we're one company. They may have different name subsets, but it's all part of one company. And I think that's where the opportunities are going to lie. I hope that answers that last question.
Hello, Marco Linte from Barclays.
The first question is on capital allocation. So basically, you are estimating the potential of potentially divestment up to 3 billion, which might be invested into M&A. But let's say in the worst case scenario where you are not able to disinvest, basically, are you happy to take on board more debt and still carrying on with your M&A opportunities, or basically all the M&A acquisitions are not on the table anymore? This is the first question, and the second question is on Abertis. We appreciate the slides and the numbers that make our analysis, let's say, a bit easier. But to what extent do you think you have been conservative in estimating those numbers, and what leaves you comfortable with those estimates going forward? Thank you.
So starting with the first one, you're right. We haven't included in our analysis raising debt for the opportunities, but we do have, in that sense, a lot of firepower, right? We are currently at $400 million euros net cash position. This is not going to impact in that sense, because from an adjusted perspective, a lot of that is being taken into account. So when you take into account just the 1 billion per year, 500 million less cash flow, and the increase that we're going to have from 24-26, we do have operational firepower, plus, if we don't include the non-core assets, the additional debt. So we're not going to give up on opportunities because of lack of non-core divestments, which is your question. And on Abertis, Pepe, do you want to answer the question? So the question on Abertis, if I understood correctly, was how conservative we've been, how conservative we have been on the figures of Abertis. And before Pepe answers, on purpose, we didn't include extensions. On purpose, we didn't include M&A, which is the only thing that could have made us more or less aggressive or conservative. But Pepe?
No, I think it's realistic. There isn't any aggressive assumptions on that. It's based in the track record, in the performance linked to traffic and toll rates. And a part of that, there is no extension, there is no M&A included. It's very, very realistic, I say.
And the one thing that potentially could have been conservative, and please Pepe and Martin confirm, is what Martin was explaining about being very simplistic and putting the perpetuity until 2038. Because certainly with refinancing, we would be able to start increasing the dividends before. That's a part of we've been conservative. Victor?
Hi, Juan. It's Victor from Westside. I have only one question. What is the major risk that you see for your plan going forward? Thank you.
No, what's a major risk we see for the plan? I am not seeing any at this stage. And this is what I was saying before. Because that question came 2 years ago, right? And there were a lot of assumptions. How we go from civil building contractor into what we are today. And that was a difficult question back in 2022. But, right now, it's rock solid. If we don't, what's the worst thing that can happen? That we don't win some of the projects we have identified on the infra space, we'll win others. That we don't manage some of the extensions with Abertis are not included in the plan. That we don't do M&A, we're not including in the plan. That the world stops the artificial intelligence race, I struggle to see that. That the energy transition is going to put a brake, I don't see that, and we are pretty much in our plan is the one in Australia. We're not including anything out of Australia. So it's a safe bet when it comes to renewables. I don't see anything. We're very much aware of E&C. Nowadays, we are very much aware of what's the potential unwinding that I explained before 24-25. If there's any issue, we have the right provisions, and the potential cash has been taken into account in our figures. We're very comfortable. with what we have explained.
Yes, quick one. Outside of Turner, where do you see the biggest opportunity for margin expansion in the businesses? Because we have de-risking at Dragados, we still have de-risking at CPB. So could we see biggest progress potentially at Flatiron from a low base, further progress on UGL, just to help us understand whether we have a bit of buffer versus top-line driven growth and a bit of buffer on the margin side?
I would say I believe that the source blue component for all of the advanced technology world, with both data centers and EV batteries, which is really taking off. We're in basically our infancy, but we really believe that source blue is going to generate at that 8%, 6 to 8% margin on top of the revenues that we currently have now, is going to be a big differentiator for us, number one. Number two, it's going to help us grow our margin, including the self-perform. But I think that we have over 300 people in the Source Blue operation today. It's 20 years old, and they're fully directed to help support the advanced technology sectors in the company. So I really believe that Source Blue is going to be very, very vital to the margin growth that we see when we're at 3.5% in 2026.
But Source Blue is, so I think that on the slide, was expected to grow 15% CAGR for 1 billion. I mean, even on 6-8% margin we're talking relatively small numbers. Is this scalable to a 2 billion, a 3 billion procurement entity as you scale up in DCs? I mean, is there a step change really to take this into a totally different scale?
Yes, I think it's unlimited, and that's just the Turner portfolio. The other portfolios that we would be working with is all of the Australian companies, CIMIC, Sedgman, Leighton Holdings, and all of those companies, or also whatever they're going to be, whether it's in the advanced technology business or the building business, we are going to expand our services into CIMIC and have that opportunity also. That's not in our plan today.
Okay. And Flatiron and Dragados, any hope?
Well, the whole idea is to joint venture more with Flatiron and Dragados wherever we can, and we have a very, very good, clean joint venture that we're building. As you saw before, a $2.8 billion airport in San Diego. So when we recently met, when Javier Sevilla met with the CEO, and I met with the CEO different time, they look outside, they see one building. They see one building. They see a terminal, and they see all the civil work. They see one company. And this has been the sweet spot for us. So we're thinking about how do we take it and find other opportunities in other parts of the country where we are, where maybe not Dragados is or Flatiron, but how can we do that together? So that's going to be a very, very big opportunity for us, and it's been quite successful. The margins on the San Diego airport, because of the Flatiron joint venture, are much higher than we've seen in the past.
And one thing in that sense, you would be very pleasantly surprised to see the contribution of E&C in the future to the business. Not that we are increasing the margins. The margins have always been, in theory, very good in E&C, but one project going wrong pretty much would sweep the rest of the jobs. That's the problem with E&C. But the margins are super healthy. By the risk in the backlog, we're going to see a very powerful E&C, not far away from now. And the contribution to the business plan is important. So we're very comfortable with that. And coming back to Turner, I mean, Source Blue is the one that can grow significantly in revenues. But certainly, all these sectors I mean, semiconductors is another example, a lot of the I mean, a lot of the advanced technology projects, they continue increasing margins. So, I mean, I think that we have a healthy plan.
And one last one on Turner. How much cash do you need to operate? Do you really need to sit on 2 billion euros of cash, net cash right now? Can you operate on less, or do you need that cash for bonding, for guarantees, and so on, to keep feeding the business?
I mean, from a cash flow perspective, as a policy, general policy of ACS, we really want every business to be autonomous, right? For good and for bad. We try not to support our businesses' cash flows, right? Because that creates a DNA and a mentality when it comes to liquidity, when it comes to doing business, right? So there's a big part of that that leaves that cash into Turner, right? So there's a big part.
So $2 billion net cash for $20 billion revenue. That's the rule of thumb.
The point is, if we have strong operating units in the different markets and strong standalone, they're in a better position to access capital markets, like the case of CIMIC, for example, or face the clients with a strong balance sheet, which is a competitive advantage and isolates the risk in the different parts of the business to make them accountable for the risk they take on board. So that's as a general principle across the group, which ends up in high cash-generating businesses keeping some cash, like in this particular case of Turner, but that's the general principle.
And in the same line, imagine that we were starting to get all the cash from the different companies. Automatically, ACS will need to start giving guarantees everywhere for the projects. Even you believe that an alliance or a cost plus, the clients are going to compare that Turner or that UGL with the competition. If they are competing with AECOM and they see their balance sheet and they see the balance sheet, right? Two options. One, giving guarantees above. Two, you're too small to compete. Yeah, but it's non-risk, it's cost plus. It doesn't matter. I want to make sure that I'm dealing with a strong company, right? So we want to make sure that every company, and Turner has the balance sheet to compete with the big firms in the US. It's a different dimension. Turner, if we take that cash, we move away, we bring to Europe, won't be the same, won't be as successful. Okay, if there's no further questions, thank you so much, everyone, for being here. Of course, you can always follow up with any Q&A, and we will be obviously reporting very soon on our AGM. We will be reporting our Q1s, and we will be able to address any further question or comment. But for now, thank you so much. Hopefully, you found it productive, and I look forward to seeing you, more of you. Well done.